Yes. So yesterday we started with the chapter of basic concepts. We have already discussed few topics, few small topics which are comparatively less important from the examination point of view. Still, let us revise those. I would be asking you a few questions and you should answer. Shall we begin? Very good. There are how many pillars of democracy? Number one, legislature. What is the job of legislature? To make the law. You should answer in not more than 2 words or 3 words. Yes, everything is written here. It is open to examination. Second pillar of democracy is executive, also called as administration. What is the job of administration? Implement the law. Third pillar is circulars which are favorable to us, and we will not accept the circulars which are unfavorable. Is that very, very clear? Okay. So this point, I think we had skipped this point yesterday. So once again we move back to this. This is written in the book. Don't worry about that. I'll show you on which page it is. Page number 3. Page number 3, point number 1, point number 4, circulars and notification. Para 1 says what? Circulars are issued by CBDT from time to time to deal with certain specific problems. With respect to what? With respect to interpretation of law. To clarify certain doubts with respect to scope and the meaning of provision. It is issued for the guidance of the officers and SSC. It is issued only for the purpose of guidance, but it is definitely binding on the department. The department is bound by the circular. These words are very, very important, so you can underline these words. Department is bound by the circulars. Such circulars are not binding on the SSC, but they can take advantage of those circulars which are beneficial to them. Have you understood this very clearly? Yes or no? Everyone should respond. You want some breakfast? Morning when you come, do you eat something? Do you want energy drink? No? Then everyone should respond. I need response from the last benches first. Are you getting my voice? You want me to arrange one mic for you also? Anyway, so income tax law consists of 5 things. Number 1 is Income Tax Act of 1961. Number 2 is Income Tax Rules of 1962. Number 3 is Notification and Circular, which is issued by the CBDT. Number 4 is Case laws is an outcome of judiciary. The case law which is decided by the High Court is binding on the state, and the case law which is decided by the Supreme Court is binding on the entire country. Is that very, very clear? Okay. Now my question to you is, I am asking very simple question. Say for example, in a Gujarat High Court, there was one case which was going on, which was concluded, and the decision given by the Gujarat High Court in that particular case is beneficial to the taxpayer. I belong to the state of Maharashtra. There is no such case in the state of Maharashtra, but there was a similar case in the state of Gujarat, and the decision was given by the Gujarat High Court in favor of taxpayer. So that decision is binding on the people who are residing in the state of Gujarat. But the question is, can a person who is residing in some other state, he is belonging to some other state, can he take the advantage of that decision of Gujarat High Court? Yes or no? So in his case, whenever the case is going on, in his case, he can give a reference to the case law of the Gujarat High Court, saying that in this year, in so and so case law, facts of the case were similar to my case, and the decision was given in the favor of taxpayer. So he can show this case law to the High Court or whatever is the appellate authority, and appellate authority, if he agrees, then in that case also he will give the decision in the favor of taxpayer. So the decisions of one High Court, they are not binding on the High Court of other states, but those decisions can be used as a reference. Those decisions can be used as a reference. So taxpayer would like to take up some cases wherein the decisions can be given in his favor. He would, whenever he is filing an appeal, he will prepare a grounds of appeal. There is something called as grounds of appeal. Why the taxpayer feels that whatever interpretation he has taken is correct. For supporting his ground of appeal or supporting his interpretation, he might present some case laws which are in his favor, so that the decision can be given by the courts in his favor. Is that very, very clear? So as a taxpayer, I can adopt the case law of some other state also, definitely only if it is beneficial to me. If it is not beneficial, I will not disclose that case law to anyone. Is that very clear? Okay. So case law is the outcome of judiciary. What is the fifth point? Annual Finance Act. Annual Finance Act is part of what? Part of budget. Budget document is divided in two parts. Some information relating to taxes and some information relating to other than taxes. All the information relating to taxes like amendment of any provision will be forming part of your Annual Finance Act. Budget is passed on which date? February, first day of February it is proposed. Then it is passed by the Parliament in the monsoon session. For your examination, which budget is applicable? Budget 20. Budget 20 is applicable to which previous year? Previous year. Oh, forget about the previous year. You tell me budget 2020 is applicable to which financial year? 2021. When I give budget in the month of February 2020, the financial year 1920 is nearly ending. So the budget 2020 would not be applicable to the financial year 1920, it will be applicable to the financial year 2021. So we can say that budget 20 is applicable to the previous year 2021. And what is the corresponding assessment year? 21-22. Is that very, very clear? Okay. So this we are discussing different constituents of income tax law. Then we moved on to Income Tax Act. Income Tax Act. What is the structure of Income Tax Act? Income Tax Act is divided into how many chapters? 23 chapters, which are further divided into how many sections? 298 sections, which are further divided into numerous subsections, clauses, subclauses, parts and subparts. What is first section of the Income Tax Act? Introduction section, which is divided into how many parts? 3 parts. What is the first part? Short title. Short title is nothing but the name of the Income Tax Act. It says this act will be called as Income Tax Act 1961. What is part 2? Extent. So this Income Tax Act is applicable to which part? It is applicable to the entire country, including the state of Jammu and Kashmir. Number 3, it is applicable from which date? 1st April 1962. Then we moved on to section 2. Instead of, what is section 2? Definition. We did not understand any definition, but we understood the different types of definition. We broadly understood how many types of definition? 3 types of definition. The definition which is very narrow in scope or very restricted in its meaning is called as exhaustive definition. Exhaustive definition will use which word? It will use the word means. Then we moved on to next one, which was an inclusive definition. Inclusive definition will use the word include. The scope of the inclusive definition which will be much wider as compared to the exhaustive definition. When it comes to inclusive definition, it would include 2 things. Number 1, general meaning as per the dictionary, plus something which is not taken into the meaning of that particular word as per the dictionary, that will also be included in the definition. So inclusive definition is comparatively wider in scope as compared to the exhaustive definition. Is that very, very clear? And whenever any definition uses the word means as well as include, the definition is called a hybrid definition. So we discussed this much part when it comes to section 2. Then we moved on to this section, charging section. Before that, I told you that any law in this country can be classified into 2 different categories. Which are those 2 categories? Revenue law and administrative law. By making any law, if government is going to collect taxes, then it is called as a revenue law. If government is going to manage the things or administrate the things, then it is called as a administrative law. Companies Act, Partnership Act, all these are administrative act. Income tax law, GST law is a revenue law. Government is going to charge the tax, government is going to earn the revenue out of this law. So this will be called as a revenue law. In every revenue law, there is a separate section called as, there is a separate category of section called as charging section. What is charging section? Charging section will tell you tax is levied on what? What is chargeable to tax? So in Income Tax Act, which one is the charging section? Section 4 is charging section. So as per section 4, what is chargeable to tax? Total income is chargeable to tax. Whose total income is chargeable to tax? Every person. Total income earned in which year is chargeable to tax? In the previous year. It is chargeable to tax in which year? In the assessment year. And where the rates of tax are given? in the Annual Finance Act, whereas certain rate of tax are given even in the Income Tax Act. Correct? So this is what we had discussed in section 4, which is the charging section. So then we moved on to different definitions. The first one being definition of a person. Definition of person is an inclusive definition or exhaustive definition? Inclusive definition. It includes how many points? 7 points. It says what as per section 2, clause 31 or subsection 31? Clause 31. As per section 2, clause 31, person includes number 1, individual. Very important point to be noted here is the word person, the word individual will also include the minor child. That is what we discussed yesterday. Person also includes HUF. I asked you to read that HUF part which is given on page number 4. Have you went through it? Do you have any doubts there? No? Sure? Yes, any one of you last benches, second last? Manoj? Any doubts in HUF? No? Is that very clear? See, these things generally they are not asked in the examination. It is not why the examiner would like to waste his marks on such kind of things. He has a lot of things to ask. So HUF we have referred. I don't think there is need to discuss anything here. So in the definition of person, number 1 is individual, number 2 is HUF, number 3 is firm, number 4 is company. Here also I gave you 1 point as homework. You need to you are required to identify what is the difference between a Indian company and domestic company. Can you give me 1 point of difference? What is the difference between an Indian company and domestic company? Domestic includes, she says that domestic includes registered as well as non-registered. One at a time. It need not be listed as per the Companies Act. Or what else? So companies would generally give dividend wherever the shareholders are situated. Domestic company will give dividend within India, and Indian company can give dividends outside India. No. Since you have referred to the provision rightly, but the interpretation is incorrect. The point which you have picked up, dividend, that is correct, but your interpretation with respect to that is incorrect. So what I'll do, I'll explain you the difference between a domestic company and Indian company by taking a very small example. Now you don't refer it. Forget about that. Shall I proceed? Okay. So what we need to understand, what is the difference between a Indian company and a domestic company. Now Indian company, I don't want to get into the details, but in a very simple language, Indian company is what? Indian company is a company registered in India under any act, whether under the Companies Act 1956 or maybe Companies Act 2013 or any earlier law also. So Indian company means what? Company which is registered in India. No one is going to ask you the definition, but you should at least know what is the difference between an Indian company and domestic company, because at this point people might get confused. So company which is registered in India is called as Indian company. Now point number 2 is what is the meaning of domestic company. Say for example, in India we have a company called as Reliance Industries Limited. Reliance Industries Limited is having one subsidiary. Do you understand subsidiary company? Yes. So Reliance Industries Limited is having a subsidiary company called as Reliance Jio Communication Limited. There is one company called as the Reliance Jio Communication Limited. They are into the business of telecommunication. So for example, Reliance Jio Communication Limited. This is which company? This is the Indian company registered in India. This is an Indian company registered in India, It is a subsidiary of Reliance Industries Limited. Now, Reliance Industries had an intention of doing the communication business throughout the world. So slowly, they are expanding their business to other countries. So definitely they would start by the countries which are nearby to India. So they decided to start the telecommunication business in Sri Lanka. So what they will do? They have two options. Option one, they can go to Sri Lanka, they can set up one branch in Sri Lanka, and through that branch they can start the telecommunication business in Sri Lanka. The other option available to them is go to Sri Lanka. In Sri Lanka, form one company as per the company law of Sri Lanka. So they will go to Sri Lanka, they will register one new company as per the company law of Sri Lanka. That company will be called as which company? Foreign company, because it is registered where? Outside India. So say for example, there is one company, Reliance Jio Sri Lanka Limited. This company is registered where? This company is registered in Sri Lanka. So this is a foreign company. This is a foreign company. Now say for example, in this foreign company, there are few investors who belong to India. Say for example, Mr. Mukesh Ambani has invested in this company. His wife Neeta Ambani has also invested. Reliance Industries Limited has also invested. So can I say these all are Indian shareholders? And there might be few people from Sri Lanka only, they might also have been invested in this company. So there is a general public belonging to which country? Sri Lanka, they have also invested in this company. Now this company, which is Reliance Jio Sri Lanka Limited, will do the telecom business in Sri Lanka. Their business will be restricted to the country of Sri Lanka. They have done the telecom business, they have earned the profits. Out of that profits, they are going to distribute dividend to the shareholders. But their few shareholders are situated in Sri Lanka, so they can easily distribute dividend to them there only. But what about the shareholders which are situated in India? Will they be required to go to Sri Lanka to collect the dividend? Then what is the other way around? What is the other option? Company has to do certain arrangements. Company has to do certain arrangements for payment of dividend in India. How these arrangements can be done? Company can appoint someone as an agent. Company can appoint someone as an agent. Give him the details of shareholders, like what is the name of shareholder, what is the address of shareholder, what is the bank account of shareholder, and that agent will transfer the amount of dividend to the bank account of the respective shareholder. If this arrangement has been made, if this arrangement for what? For payment of dividend to the shareholders which are situated in India, if this arrangement is made, then this company, even though it is a foreign company, for the purpose of Income Tax Act, this company will be called as a domestic company. This company will be called as what? Will be called as domestic company. So if I want to conclude in one line saying that what is the meaning of domestic company? Domestic company is a company, it might have been registered where? Outside India, but they are having shareholders in India, and they have made arrangement for payment of dividend in India. Such foreign company can be called as what? It can be called as domestic company. Have you understood this very clearly? Say yes or no. See, you should understand that there are a few complex topics which will come maybe chapter number 4, 5, etc. At that point of time, you need to respond to me after the completion of each and every point. So you need to develop a habit of responding. There is no other way around wherein I can understand whether you understood or not. So at the completion of every topic, or whenever I ask you, have you understood, you should respond clearly. And if you are not understood, you should say no. It is my job to ensure that how to make you understand. But at least you should communicate me that you have not understood. Is that very clear? Shall I proceed? So what is domestic company? company registered outside India, having shareholders in India, and they have made arrangement for payments of dividend in India. Is that very clear? Now the question is, this foreign company is having shareholders in India. Now this foreign company has made the arrangement for payment of dividend in India. This foreign company will be called as a domestic company. What is the advantage of company becoming a domestic company? Their tax rates are lower. In case of domestic company, the tax rate is 30%. Whereas in case of foreign company, the tax rate is 40%. So if you are a domestic company, you have to pay tax at lower rates. Have you understood this? Okay. So second point which was given to us homework is completed. Once again we move back to the definition of person. Person includes number 1 individual, number 2 HUF, number 3 firm, number 4 company, number 5 association of person or body of individual, whether incorporated or not, number 6 local authority, and the last one is every artificial juridical person which is not covered in preceding subclauses. Is that very clear? Okay. So this we have revised. Then we moved on to what? Then we moved on to the definition of previous year and assessment. Can you tell me what is assessment year? Assessment year is a period of how many months? 12 months. It will begin on which date? 1st of April every year. So the conclusion is what? Assessment year is always a period of 12 months. Is that very clear? Okay. What do you mean by previous year? Previous year means which type of year? Calendar year or financial year? Financial year immediately preceding the assessment year. So if I say your assessment year is 21-22, your previous year would be 20-21. So previous year means a financial year immediately preceding the assessment year. Yesterday we discussed that in certain situations, previous year can be a period of less than 12 months. How many situations? 3 situations. Number 1, when you set up a new business or when you set up a new profession or new source of income has come into existence during the previous year. In that case, your previous year will start on which date? It will start from the date of setup of business or the date of setup of profession or the date on which the new source of income has come into existence, and it will end with the said financial year. So the ending date of the previous year is same, but the starting date can be different. Is that very, very clear? So definition of previous year is given in which section? Section 3. Section 3. Definition of, this is the only definition which is given outside section 3. We have some other definitions also which are given in some other sections. But mostly most of the sections, most of the definition would be given in which section? Section 2 itself. So previous year definition is given in section 3. So I think till this point we have discussed the theory yesterday. Okay. See, first session I would plan out my lecture in such a manner that first section, that's the first part of the lecture, that is 7 to 9, will always be theory, so that you are fresh and we can understand in a better manner. And the last session, see, generally income tax subject, it is very vast and lot of processing is required in your mind to understand the concepts. So continuously 6.5 to 7 hours, I do not know whether you have developed that much amount of capacity or not, but last 2 hours are difficult to manage in some cases when the chapter is more of theory. So I would plan out my session in such a manner that the last 2 hours will always be doing the practical questions. I would plan out, I don't guarantee that, but I would try to plan out in such a manner that the last 2 hours will always be doing the practical questions, which would involve a lot of calculations. So theoretical aspects will be discussed In the first 2 hours, then we'll have a break of 30 minutes or so for your breakfast, and then once again we may discuss some theory. And second part, the last 1 hour, and the third part will always be a question solving part kind of thing, so that you can apply your mind, you can do the calculation. Is that very clear? Okay. Now, I explained you that Section 4 is the charging section of Income Tax Act. Now, tell me in one sentence, what is charging section? What is the importance of charging section? Why you need a charging section, or what is the job of a charging section? It tells you what is chargeable to tax. Do we have only one charging section throughout the Income Tax Act, or you have multiple charging sections? You have multiple charging sections. So now we need to understand that for charging tax on any income, you need two types of sections. See, there are different types of sections. Sections can be classified into different categories. The first one was introduction section, section 1. The second one was definition section, that is section 2. Then the third one is charging section. And similarly, the fourth category of section is called as machinery section. Machinery section is also called as computation provision. Computation provision will help you to compute the amount of income. It will help you to compute the amount of income. So if I tell you, for example, you don't move anywhere, I will tell you what to read, where to read. Don't worry about that. You just listen to me and understand the things. If something is not written in the textbook, this PDF, whatever is appearing in front of you, this will be given you as part in that WhatsApp group itself. So don't worry about that. You just focus on understanding, and if something is required to be written, I will tell you where to write. So this you can write somewhere near to section 4, not now. Please understand. Once you have understood, you can refer it later. You can write it later if you have understood. If you have not understood and you have written something in notebook, there is no point in writing if you are not understood. So your priority should be to understand the things, not copying the things. Yes. So for charging tax on any income, you need two types of sections. And I'm not saying two sections, I'm saying two types of sections. The first one is called as charging section, and the second one is called as machinery section. The first one is called as charging section, and the second one is called as machinery section. What is the job of charging section? Job of the charging section is tell you which income is chargeable to tax, or on fulfillment of which conditions income would be chargeable to tax. Machinery section would help you to compute the amount of income. It would help you to quantify the amount of income. See, if I say, for example, the government comes out with a law saying that every human being has to pay the tax. I'm taking a hypothetical example. Same example I took yesterday also, if you recollect. Government says every human being has to pay the tax. Referring to this sentence, can you ascertain the amount of tax? Can you ascertain whether you have to pay 100 rupees as tax or 200 rupees as tax? How much amount of tax you have to pay? Can you quantify? No. But can you say that tax is levied on what? Yes, tax is levied on every human being. So this section will be called as what? This section is which type of section? This is a charging section. This is telling you what is chargeable to tax. Now, to quantify the amount of tax, government will have to insert one more section called as computation section, or also called as computation provision, which will help you to compute the amount of tax. Say, for example, government says tax is levied based on the height of individual. If the height is 5 feet, you have to pay 50 rupees. If your height is say 6 feet, you have to pay 60 rupees. Now, can you quantify the amount of tax? Yes, very easily. So, this section in which it says that tax will be levied based on the height of individual or maybe weight of individual. In that case, this section will be called as which type of section? This will be called as a machinery section, It is helping you to quantify the amount of tax. Is that very, very clear? So for charging tax on any income, you need how many types of sections? Two types of sections, charging section as well as machinery section. Is that very clear? So I say that there are four combinations, or there are four possibilities. For a particular income, there is a charging section, but you could not find out a machinery section in the entire Income Tax Act. Whether that particular income would be chargeable to tax or it will not be chargeable to tax. For a particular income, there is a charging section in the Income Tax Act which says that yes, this income is chargeable to tax. But for quantifying the income as to how much amount is chargeable to tax, there is no other provision. So the question is, will that income be taxable or it will not be taxable? It will. For charging tax, you need how many types of section? Two types of section, charging section as well as machinery section. I am saying you that for a particular income, there is a section which says that yes, this income is chargeable to tax. But there is no section which is giving you the procedure of computation of income. In that situation, do you believe that particular income will be taxable or it will not be taxable? It will not be taxable because it is not possible to quantify the amount of income. Is that very clear? So broadly we can say that we can divide this into four situations. Situation 1, there is a charging section but there is no machinery section. Means can you quantify the income? No. So whether your income will be taxable or not taxable? Not taxable, not taxable. Is that very clear? Are you understanding? Okay. Second possibility, you don't have the charging section. Means in income tax, there is no section which says that this particular income is taxable. But there is a procedure to compute the income. There is a procedure to quantify the income, but there is no section which says that this particular income is chargeable to tax. In that case, whether your income will become taxable or not? No, it is not taxable because charging section is missing. Charging section is missing. What is the third possibility? Charging section is also absent, it is missing, and machinery section is also missing. If one of them is missing, then the tax is not levied. If both of them are missing, then it is implied that tax will not be levied. So tax will be levied only in one situation. What is that situation? You have the charging section as well as the machinery section. Is that very clear? So along with section 4, charging section, we also understood that when your income can become taxable, it can become taxable only if there is a charging section as well as the machinery section. Have you understood the clear distinction or difference between them? Yes, yes or no? Okay, okay. So this discussion with respect to charging section, machinery section is also over. Yesterday we also discussed that for your examination, which budget is applicable? Budget 2020 is applicable. When we say budget is 2020, what is your previous year? 2021, and the corresponding assessment year is 21-22. Is that very clear? Okay. Then we moved on to how to compute the total income, and then we discussed how to compute the tax liability. Our discussion with respect to computation of tax liability is not completed. It is in between only. We have only understood how to calculate the basic tax. Do you recollect that? Okay. Right now I don't want to do the discussion of calculation of tax liability. Right now I'll move on to theory. So I'm moving on to page number 7 of your book. Page number 7. Page number 7, there is a definition of SSE. There is a definition of SSE. Yes. Shall we start? Okay. So we are on which page? Page number 7. We move on to the definition of SSE. Definition of SSE is which type of definition? Hybrid definition. Hybrid definition. It says SSE means a person. SSE means a person. What do you mean by person? Person includes those 7 points. SSE means a person by whom any tax. What do you mean by any tax? Any tax means, are we talking about GST here? Or we are talking only about income tax? What do you mean by any tax? Any tax means will it include municipal tax, GST, everything? You are learning which law? Income tax law. The confusion which has arisen in your mind, the same confusion can arise in the mind of any taxpayer. Therefore, government has also defined the word tax in the income tax. Government has also given the definition of word tax in the Income Tax Act itself. It says tax means income tax chargeable under the provisions of this act. So in this entire book, wherever the word tax appears, what is the meaning of it? Income tax only. It will not cover any other tax. Is that very, very clear? So here when we say any tax, the word any should not be given that much importance. The word any is not having that much amount of relevance. And when we say tax, it includes only the income tax. Is that 100% clear? So it says SSE means any person by whom any tax, that is income tax, or any other sum of money is payable under this act. What do you mean by this act? This act means Income Tax Act 1961. So any person who has to pay some amount of tax to the income tax department, that person will be called as a what? That person will be called as an SSE. Besides tax, this definition is also using the word any other sum of money. Say for example, I was required to pay the tax by 30th of April. I am just giving a hypothetical example to understand the situation. For example, I was required to pay the tax by a particular date, and that date was 30th of April. But instead of 30th of April, I have paid the tax, but I have paid on 31st of May. So can I say I have delayed the payment of tax? So question is whether any tax is still due from me or it is already paid. Tax is paid on which date? 31st of May. So is there any liability? Or the liability is already paid off? Liability is already paid off. Instead of paying it in the month of April, it is being paid in the month of May, that's all. But the payment is already done. So no tax is outstanding. No tax is outstanding. But since I paid the tax after the due date, government may charge some amount of interest to me. Or in certain situations, government may also levy the penalties. So if in our example, no tax is due, whatever tax was required to be paid by me, I have already paid the tax. So there is no tax liability outstanding. But since I paid the tax after the due date, government may charge some amount of interest to me, or it may charge some amount of penalties to me. If that penalty is also yet to be paid, then also I will be called as an SSE. So here it says SSE means any person by whom any tax is payable, or if at all the tax is not payable, tax is already paid, then some other amount of money is payable. The word any other sum indicates what? It indicates either interest or it may indicate some penalty. So you can write here interest, penalty, etc. The word any other sum indicates what? Interest, penalty, etc. So definition, the first sentence says that SSE means a person by whom any tax is payable or any interest or penalty is payable, but they are not using the word interest and penalty, they are using the words any other sum of money is payable under the provisions of this act itself. Is that very, very clear? Besides that, SSE also includes the following three types of persons. SSE also includes following three types of persons. For example, Manoj's father is doing business. He has paid entire amount of tax to the government. Nothing is payable. Now, for example, wherever his business premises is situated, in that locality, in that area, some income tax survey is going on. Some income tax survey is going on. Every day, 2 hours, he also goes to that shop, his father's shop, and he sits in the cabin, or he may sit at the cash desk. And say for example, his father has went to some other place for work, and during that time, some income tax survey is going on in that locality. When that income tax survey is going on, the officers of the income tax department would, they can move on to any shop and they can give the form, they can ask the person to fill up the form, fill up his name, etc., and submit that form in the income tax department. Now Manoj is sitting in that shop, he doesn't know anything, he has just started learning the income tax, he just knows the basics. So he has got the form from the income tax department officer saying that you fill up this form and submit to the income tax office by tomorrow. So what he has done, he has filled up that form in the name of taxpayer. He has written his father's name, he has written the previous year, assessment. A lot of questions are asked. Number one, do you own the car? So Manoj says yes. So next question they have asked, how many cars? So Manoj says that we own 4 cars. Do you own flat? So yes or no, he has checked mark, yes. How many flats? So he has written 4 flats. All these details he has filled up and he has submitted in the income tax department. Now after 1 month, his father has received a notice from the income tax department that we have come to know from our secret sources that you are owning 4 flats and 3 luxury cars. We also refer to your income tax return, wherein you are declaring an income of only 6 lakhs per annum. If you are earning only 6 lakhs, how can you own property worth crores of rupees? So we ask you to meet so and so income tax person on so and so date at particular office. Now the question is whether any tax is yet to be paid by his father. No, he has paid all his tax liability. No tax is outstanding, no penalty is outstanding, no interest is outstanding, everything is paid, everything is up to date. But the income tax department has sent a notice to his father. With what intention? With the intention to find out the correct amount of income earned by him. Now the income tax department is having a doubt whether, saying that whatever income tax return he has filed and whatever income he has declared in that income tax return might be wrong. So the objective of the income tax department is to ascertain the correct amount of income. They feel that he might have done some tax evasion, he has declared very less income, so they have sent a notice to him. But as of now, no tax is outstanding, no penalty or no interest is outstanding. But income tax department has initiated some proceedings. They have initiated some proceedings against him. Any person against whom income tax department has initiated the proceedings, that person will also be called as an SSE. That person will also be called as an SSE. Why the proceedings are initiated? To find out the correct amount of income earned by him. Is that very clear? Yes or no? Okay. Yesterday we also understood one more point, saying that minor's income is also taxable. We understood that minor is also included in the definition of person. So the question arises whether the minor's income is taxable, my minor child's income is taxable or not. Answer is yes. We will understand in the chapter of clubbing of income, which says that minor's income will not be taxable in the hand of child only, it will be taxable in the hands of parent. So minor is not required to pay the tax on the amount of income earned by him, parent is required to pay the tax. So the income of the minor will be added to the income of parent. So if you want to initiate some proceedings against the minor child, will you initiate the proceedings against the minor child or you will initiate the proceedings against the parent? You will initiate the income tax proceedings against the parent, not against the minor child. So in that case, the objective of the income tax department is not to assess the income earned by that person. Their objective is to ascertain the amount of income earned by some other person. Are you understanding this? So, minor's income is taxable in the hands of parent when the income tax department feels that the minor child has evaded some tax, he has not disclosed the entire amount of income in the income tax return, and income will be added to the income of father only. but the department feels that the income is not fully disclosed, in that case department will initiate action or initiate the notice in the name of parent. Are you understanding? But what is the objective of this notice? To ascertain whose income? To ascertain the minor's income, not to ascertain the parent's income. Is that very clear? So if the notice is issued to you, if the notice is issued to any other person to ascertain his income or to ascertain someone else's income in respect of which that person is assessable, in that case that parent will be called as an assessee. So there are two possibilities here, or there are two situations. Number one situation, when the notice is sent to you to ascertain your own income. And number two situation, when the notice is sent to you, but not to ascertain your own income, to ascertain the income of some other person in respect of which you are assessable. In that case also you will be called as an assessee. Is that very, very clear? So point number one, assessee also includes any person against whom any income tax proceedings are initiated for the assessment of his income or the income of some other person in respect of which he is assessable. Is that very clear? Yes or no? So this is written in point number one. Next point is assessee includes a deemed assessee. Assessee includes a. Do you understand what is the meaning of word deemed? Have you heard the word deemed earlier? What do you mean by deemed? Deemed means assumed to be assessee. So point number two covers a situation wherein that a particular person might not be an assessee, but he will be assumed to be an assessee. For example, there is a charitable trust. There is a charitable trust. That trust will be managed by whom? It will be managed by the trustees. So if you want to assess the income of trust, the income of trust would be assessed. Who will be responsible to do get the assessment done? Income of the trust will be taxable in whose hands? Taxable in the hands of trust only. But trust is not a natural person. Trust is an artificial person. So who will represent the trust? Trustees will represent the trust. So trustee will be considered as an assessee for the assessment to be done with respect to the income of the trust. So trustee can be called as a representative assessee. He can be called as a what? Representative assessee. He is assessable in respect of income earned by the trust. So that representative assessee is called as a deemed assessee. Actually he is not an assessee, but he is considered to be an assessee because he is liable to be assessed in respect of income of the trust. Is that very clear? There is one more example. Say for example, Manoj has completed his CA and he is moving to Dubai. In India, after completing CA, he has searched for a job and he has got a package of say 6 lakh rupees per annum. Manoj says, I took efforts for 6 years to complete my chartered accountancy and these fool people are offering me a package of only 6 lakhs, meagerly 50,000 rupees per month. So I am not satisfied with this. So he has applied for some international postings. Online he has applied. In Dubai he has got a job and his package is say 15 lakhs per annum. Converted into Indian rupees. So his package is 15 lakhs per annum. So he has decided to move on to Dubai for the purpose of job. Now when he goes outside India, say for example he goes outside India in the month of September. In the month of September he goes outside India. It might happen that when he was in India during the month of April to September, say for example he is leaving India on 30th of September. He is going outside India on 30th of September, but during the period of April to September, he was in India. Yes or no? During that period, it may happen that he might have earned some income. If he goes outside India without paying any taxes on that particular income earned by him, do you feel will it be convenient for the government to collect the taxes from him once he goes outside India? No. So once he goes outside India, he will become non-resident in India. And it will be very difficult for the government to catch hold of him for the collection of taxes. So government says before you move outside India, you appoint your representative in India. So if we want to communicate something, we will communicate to your representative. If you want to collect the taxes, we will collect taxes from your representative. In that case, that representative will also be called as an SSE. He will be called as a deemed SSE. Is that very, very clear? So point number 2, SSE includes a deemed SSE. Point number 3. Do you know something related to TDS? Have you heard the word called as TDS? Tax deducted at source. Whenever you earn any income, say for example, you have earned an income of 10,000 rupees. Do you believe that you will receive entire 10,000? Or the person who is paying you income will deduct some amount of tax? He will definitely deduct some amount of tax. For example, I am rendering professional services to Inside Commerce Studies. They will pay me professional fees. While paying fees to me, they are going to deduct some amount of tax, and this tax they will pay to the government. So, Inside Commerce Studies, they are payer. They are paying me income. For them it is an expenditure, but when it comes to income tax, we use the word income. They are paying income, I am receiving income. So they are payer, I am paying. While making a payment of, say for example, 1 lakh rupees to me, they are supposed to deduct a tax of 10,000 rupees. And they are supposed to pay me the balance of 90,000. Who has given the duty to them, or who has given the responsibility to them, or who has given the right to them to deduct the tax? Government of India through the Income Tax Act has given the right to the Inside Commerce Studies to deduct the tax. Means they are assigned some duties under the Income Tax Act. They are assigned some duties under the Income Tax Act. What duties they are being assigned? They have to deduct the tax whenever they pay some amount of income to any person. Is that very clear? So, for example, they are supposed to deduct tax, but they did not deduct the tax. They forgot to deduct the tax. When we say they forgot to deduct the tax, means what? They have paid how much amount of income to me? They have paid entire 1 lakh to me. In that case, can we say that they have performed the duty as assigned to them under the Income Tax Act, or they have failed to perform their duty? They have failed to perform their duty. These people will be called as SSE in default. These people will be called as an SSE in default. For example, in your college, 75% attendance is compulsory. Means you have to attend 75% lectures at least. If you don't attend at least 75% lectures, then at the end of every month, they will display a defaulter list on the notice board. And if your name appears in that list, they will charge you a penalty of say 1,000 rupees. So if a student who has not attended the college, or he has attended but less than 75%, he will have to pay a penalty. But the question is he also a student, or he is not a student of that particular college? Is he a student? Yes, but he is falling into the defaulters list. He will be called as a student in default. Some duties are assigned to him. First duty, he has to attend the lecture. If he doesn't attend the lecture, he will be called as a student in default. Similarly, under the Income Tax Act, some duties are assigned to the different people. If they don't perform their duty, they will be called as an SSE in default. Is that very, very clear? So with this, we have completed the definition of SSE. We have completed the definition of SSE. Do you expect me to read each and every sentence here in the class? No, na? I cannot, because we don't have that much time also. See, this kind of definition will not be asked to you in the examination, but you should know the meaning. Once I explain to you, definitely at home you should refer, and if you at all have any doubts, please do ask in the next lecture. Is that very clear? So today we have completed the definition of SSE. Now we move on to the definition of assessment. This is one of the smallest definition in the entire Income Tax Act. This is what? Definition of assessment. Forget about what is written in the definition. Do you understand what is the meaning of term assessment? What do you mean by assessment? For example, you appear for the CA Institute examination. You appear for the examination means you will go in the examination hall, you will write the answers in the answer sheet and you will submit the answer sheet to the officer there. What the CA Institute will be doing about that? They will do the assessment of your answer sheet. Assessment means what? They will assign the marks to each and every question. So assessment means to quantify how much marks you have scored. Similarly, when it comes to income tax, what do you mean by assessment? To quantify what? To quantify the amount of income or to quantify the amount of tax. So assessment means ascertaining the amount of income and ascertaining the amount of tax liability. So you can write here assessment. Assessment means to assess the income and assess the tax. To assess means to quantify, to ascertain the amount. So to assess means to quantify the amount of income and quantify the amount of tax. Who will do the assessment? You will do the assessment or income tax department will do the assessment? Who will do the assessment? Okay. Before you appear for the CA Institute examination, do you write few papers at home? Sitting for 2-3 years, do you write some papers at home? Why do you do that? For your own practice. When you practice by appearing few papers at home, what you are doing? You are also doing the assessment only. The assessment which is done by you is called as self-assessment. You are assessing your own knowledge, whether you recollect all the provisions, whether you are able to write all the answers properly as expected by the CA Institute or not. So first of all, you will assess yourself. And once you have completed your own assessment, you will appear for the examination and you will submit your answer sheet to the CA Institute and CA Institute will do the assessment. So what you are doing is called as what? Self-assessment. And what CA Institute is doing will be called as what? It will be called as assessment. Similarly, once my previous year comes to an end, as a taxpayer, I am expected to file my income tax return. In income tax return, I am expected to disclose what? The amount of income which I have earned and the amount of tax liability on that particular income. So for that, I will have to assess my own income. So that will be called as what? That will be called as self-assessment. Once I file the income tax return, income tax department may pick up my income tax return to ascertain whether the income declared by me is correct or incorrect. So what they are doing is called as what? That will be called as assessment. And what I do as a taxpayer will be called as a self-assessment. Is that very, very clear? So here we say assessment. The definition of assessment says assessment includes reassessment. What do you mean by reassessment? For example, what do you mean by re-exam? Appearing for the examination once again. Yes or no? Why you are appearing for the examination once again? You did not clear the examination in the previous attempt, therefore you are appearing for the examination in the next attempt. Similarly, what do you mean by reassessment? What do you mean by reassessment? Appearing for the exam, calculating your income or ascertaining your income once again. Why there is a need to ascertain your income once again? Because whatever assessment was done in the past might be incorrect or there might be some mistakes in that assessment. Therefore, the income tax department may rectify those mistakes. They may reassess your income. They may recalculate your income. remember that is more than enough for the examination. It is a inclusive definition. See, this is the biggest definition. If the examiner asks you the definition of income in the examination, you are bound to fail. No one will pass, not a single person will pass. Every student will fail. See the length of the definition. It's all these things, because at each and every point we are going to devote some 25-30 minutes time. For example, the first point says income includes profits and gains. On this we have a separate chapter, profits and gains of business profession, which would require at least 20 hours. So this is just the trailer of the entire movie. Once you watch the entire movie, the name of the movie, name of the director, you will automatically remember. So I don't want to waste my time explaining you each and every clause of this definition. I'll just refer to few important points or few important features of income. And here also, we will try to understand these things in the question answer form. First question to you is, see, these are the points which will help you to identify whether particular receipt is an income or it is not an income. These are the characters or these are the features you need to apply to a particular receipt to identify whether particular receipt is income or it is not an income. Say for example, I am doing a job. At the end of every month, I am getting a salary. Is it an income? Yes or no? Yes. I have kept a fixed deposit. I am earning interest from bank. Is it an income? Yes. I have then FD is my source. What is my income? Interest is my income. I have invested money in debentures. Debentures is what? Debentures is my source of income. What is my income? Interest is my income. So my question to you is, only those incomes which are received at regular intervals should be taxed, or every income should be taxed? If you receive income at irregular intervals, should that be taxed? Income earned very non-frequently. Say for example, Manoj went to Dubai And when he went to Dubai, there was a Dubai shopping festival going on. Do you know, once in a year in Dubai, there is a Dubai shopping festival wherein electronic products are available at least 50% discount to the MRP. And wherever there is a discount, you will find out all the Indians are present over there. So Manoj went to Dubai. He bought some electronic products. He wanted to buy a laptop. So he went to Dubai as a tourist during that time when the Dubai shopping festival is going on. Instead of one laptop, he bought two laptops. He actually needed only one laptop, but he purchased two laptops thinking that one I'll sell to someone in India, because this laptop is available in India at a higher price. Say for example, he has bought two laptops at 1 lakh rupees each, and that extra laptop he has sold to someone at 1,30,000 rupees. So what is the amount of profit he has earned? 30,000. Is he going to earn this such kind of profit every year or every month? Should this also be taxed? Yes. So government says all incomes which are regular in nature will always be taxed, but in certain situations even the irregular incomes are taxed. So it is not necessary that only regular income will be taxed. So here in every point, in each and every point, answer can be either yes or it can be no also. So if you get the answer is yes, then also income can be taxed. If you get the answer is no, then also income can be taxed. Is that very clear? Temporary income should be taxed or permanent income should be taxed? Which income should be taxed? Temporary means what? The example which I took right now, that is a temporary income. So government says temporary as well as permanent income, both will be taxed. Okay, income earned in monetary terms should be taxed, or income earned in non-monetary terms should also be taxed? What can be income in non-monetary terms? For example, the cricketers are playing cricket. For them, playing cricket is a profession. Say for example, Virat Kohli is declared as a man of the series for a particular series, and he has received a car worth 25 lakhs. So do you believe that the value of car will be taxed to him? Yes, it will be taxed to him. It will be taxed to him. So whatever earnings he has earned in form of money will be taxed, and whatever he has earned in form of non-monetary things will also be taxed. So anything which is earned in monetary terms is also taxed. Anything which is earned in non-monetary terms, it is also taxed. Is that very clear? See, when it comes to income, everything is taxed. If government says only income earned in monetary terms will be taxable, and income earned in non-monetary terms, something received in kind, is not taxable, what will happen? If government makes a provision saying that anything earned in kind is not taxable, what will happen? This entire world will get converted into barter exchange system. So everyone will pay money to each other in kind only. In that case, tax will be saved on all the incomes, most of the incomes. Are you understanding? So which income should be taxed? Both incomes should be taxed. Legal income should be taxed or illegal income should be taxed? Or both should be taxed? Both should be taxed. Few of you may think that why illegal income should be taxed. So question, the thought process which is going on in your mind is not whether the illegal income is taxable or not. You are thinking that how the department will come to know whether you have earned that you have earned the illegal income. See, how the department will come to know that you have earned the illegal income is the lookout of the department. Say for example, they are doing certain investigation. During that investigation, it has come to their knowledge that you have earned some illegal income. And if government says illegal income is not taxable, what will happen? Then people will declare that this much amount of income I want and this is an illegal income. So government says that we have made a provision for levying tax on legal income as well as illegal income. If we come to know about the illegal income, only then it can be taxed. Otherwise, definitely it can't be taxed. And people earning income from illegal sources, they are not going to disclose to the government. When it comes to the knowledge of government You can't think of paying taxes twice. So same income can be generally taxed only once. Do you understand something called as reimbursement? Have you heard about the word reimbursement? For example, Manoj is working in a company at the position of business development officer. So what is his job? His job is to get the business for the company. So for getting the business, he has to travel to different cities. He has to travel to different cities to get the business for the company. And when he travels to different cities, he will have to incur a lot of expenditure like traveling expenses, stay expenses in a hotel, food expenses, etc. So company says that you incur money, you incur expenditure from your own pocket. Once you are back from that official visit, you submit the details of the expenditure incurred by you and we will pay back that amount to you. That is called as what? That is called as reimbursement. The question here is, do you believe that amount reimbursed to Manoj by the company should be considered as income and should it be taxed? Is it an income? Then what it is? He is getting back the same amount of money which he has spent on behalf of the company from his own pocket. So it is not income for him. It is what? Whatever expenditure he has incurred, that same amount of money is getting back from the company. So this is called as reimbursement of expenditure. Generally, say reimbursement of expenditure can be divided into two categories. Listen to me very carefully. This point will be once again discussed when it comes to the chapter of income from salaries. Reimbursement can take two forms. Number one, Manoj has incurred the official expenses when he was in an official tour and those expenses are reimbursed. This reimbursement is not considered as income and it is not taxable. But say for example, Manoj is working in a company and that company has told that as per the policies of the company, whatever employee is incurring as an education cost for his children, that amount also we will reimburse. So Manoj has incurred the tuition fees or school fees of his children and he has to submit the fee receipt to his employer. His employer is reimbursing the school fees of his children also. Is it a personal expense reimbursed or an official expense reimbursed? Personal expense reimbursed. Should this be considered as income? Definitely, because it is a personal expenditure which is reimbursed. He is getting an advantage. So this amount should be considered as an income. So here you can write in your own words, personal expense reimbursed equals to income. Personal expense reimbursed equals to income. I don't have space, so you can write personal expense reimbursed should be considered as income. Comma, official expenses reimbursed is not an income. Official expenses reimbursed is not an income. Yes, is that very clear? Have you understood this very clearly? Okay. Do you recollect something called as exempt income? Do you understand what is exempt income? Exempt income is the income which is not chargeable to tax, on which you are not required to pay any tax. For example, agricultural income is exempt from tax. Agriculture income is exempt from tax. So we say that it is a non-taxable income. It is a non-taxable income. But here we have one term called as tax-free income. The meaning of the term tax-free income is not an income which is exempt from tax or income which is not taxable. The meaning is something else. For example, say for example, inside commerce studies, I am rendering professional services to them, and we have agreed that whatever tax liability is there on the amount of income which I earn, I will not pay. They will pay the amount of tax from their own pocket. Generally, what will happen? Say, for example, they are paying me an income of 50,000 rupees. Out of 50,000, they will deduct 5,000 as TDS, and they will pay me how much? 45,000. But we have agreed, we both the parties have agreed that the amount of tax will not be deducted from the amount paid to me. They will pay tax from their own pocket. So, instead of deducting tax from my income, they will pay the tax from their own pocket. whether that rental income should be taxed or it should not be taxed. It should be definitely taxed. So income tax department says that we will levy tax on this rental income in the hands of first child. But the first child he is taking an objection saying that entire income doesn't belong to me. I am just receiving it. I am also having my brother. I need to transfer 50% of income to him. But has he actually transferred? No. So who is the owner of? And generally tax will be levied in the hands of a person who has actually received the income. And at a later stage, if the case is concluded and if some property or income is given to some other person, in that case department will do the reassessment. Reassessment means accordingly they will transfer the income from the hand of one person to another person and they will revise the calculation of income. Is that very clear? Say yes or no. Do you understand the word fictitious? What do you mean by fictitious? Which is not real. Your accounting subject has started? No. Have you learned something called as departmental accounts? Where in your first year of BCom? Do you know something called as interdepartmental transfers? Yes or no? Okay. Then you might be aware that one department transfers the goods to another department, sometimes at a profit. Sometimes one department within the same organization may transfer goods to another department at a profit. The point is, say for example, department 1 has transferred goods worth 5 lakh to department 2 by levying a profit of 50,000 rupees. And these goods are lying as a closing stock in the hands of department 2. So for department 1, the amount of profit of 40,000 or 50,000 rupees, do you believe that it is a realized profit or unrealized profit? So the question is, should that unrealized profit be taxed? Is it a real income or a fictitious income? Right now it is a fictitious income because it is not actually earned. It is not actually realized. So the question is, while levying the tax, government should levy tax on realized profit or it should levy tax even on unrealized profit? Generally, it should levy tax only on realized profit, income which is already earned. But in certain exceptional situations, they will also levy tax on unrealized profit. Those situations we will discuss at a later stage. But as of now, have you understood which income is taxable? Only realized income is taxable, or we can say that only real incomes are taxable. Fictitious income means income which is not actually earned. Those incomes are generally not taxable. They are generally not taxable. So there is one point here, income should be real and not fictional. Fictional means fictitious. Fictitious means income which is not actually earned. Is that very clear? Yes, have you understood last bench? Income includes loss. What is the meaning of this? In your mind, there can be two different types of thought. A positive thought and a negative thought. The question is whether a negative thought is also a thought. Yes, positive thought is also a thought and negative thought is also a thought. Similarly, you can have two types of income. Number one, positive income. Number two, negative income. Negative income means, say for example, you have incurred a loss in the business. Now, for example, you are into two different businesses. You are into, say, textile business as well as, say, telecommunication business. In textile business, you have earned a profit of, say, 50 crores. And in telecom business, there is a stiff competition after the entrance of Reliance Jio, and now you have incurred a loss of 20 crores. So your profit of textile business is, say, 50 crores, and the loss of telecom business is 20 crores. In your opinion, what should happen? Should we allow you to adjust the negative income against the positive and only remaining positive should be taxed? Or should we levy tax only on positive and we say that negative, we are not concerned about this? Or negative should be allowed to be adjusted against positive, or it should not be allowed to be adjusted against positive? Generally, it should be allowed to be adjusted against a positive income. So when we say income, the word income includes a positive income as well as the negative income. So if I am having a positive income of 50 and negative income of 20, and if I adjust this against each other, the net income would be 30. Pin money. For example, Manoj has earned a income of 1 lakh rupees. Manoj has earned an income of 1 lakh. On that, there is a tax of, say, 10,000 rupees. He has earned an income of 1 lakh rupees on which he has already paid a tax of 10,000 rupees. So what is now available with him? 90,000. Out of 90,000 rupees, he has given, say, 40,000 to his wife to be incurred as a household expenditure. So he has given 40,000 to his wife, saying that this 40,000 you can keep it with you for household expenditure for the entire month. Now Manoj's wife, out of 40,000, she has saved an amount of 10,000 rupees. She has saved an amount of 10,000. This 10,000 is nothing but savings out of the household expenses. So the question is whether this savings done out of the household expenses should it be taxed in the hands of Manoj's wife once again? No. Why? Because that 40,000 was already a part of 1 lakh and 1 lakh is already taxed. If we levy tax once again, not on 40 but on only the amount of income which is saved, that is 10,000, that would amount to what? That would amount to double taxation. So this is called as pin money. Whatever amount is saved, in our example, what amount was saved? 10,000 rupees. That 10,000 rupees is called as pin money. That is not considered as an income. That is never taxed. Is that very clear? Second last point is Eli money. Have you heard something called as Eli money? No? What do you mean by Eli money? When divorce is given to wife, you have to give some amount of money to wife. Say for example, Manoj divorced his wife. When he got married, he was very poor. He had a qualification of CA, but he did not have huge amount of property. Sometimes say someone enters your life and he is a very lucky person for you. Your fortunes may change. So after his marriage, Manoj's fortune has changed. He has minted money like anything. Now he is having, say, crores of worth properties. But once he is having huge amount of money, he has lost charm in his wife. And he has married some, say, television actress. So he has divorced his wife, but the court has said that you pay her a compensation of 20 crore rupees. So he says that only 20 crores, I am ready to pay right now only. So he quickly signed a check of 20 crores. In the court itself, he gave a check of 20 crores to his wife. So that 20 crores is a compensation received by wife for this divorce. This compensation is called as alimony. This compensation is called as what? Alimony. Question is, should alimony be taxed? First of all, tell me, this alimony in our example, is it a revenue receipt or it is a capital receipt? It is a capital receipt, one-time receipt, na? It is a capital receipt. But can you receive such kind of alimony on a regular basis? Yes, in certain cases. For example, why the husband is not getting the compensation in case of divorce? Because you are staying in an Indian society. For that you have to stay in some foreign country wherein your wife is a earning member and you are a house husband. If you act as a house husband, in that case you might be eligible for that alimony. But that is not going to happen in this country. You will have to get shifted to some other developed country wherein your wife will earn the income and you will stay at home and manage the home affairs. In that case, if you receive alimony, that can be considered as an income. So what is alimony? If I want to ask you, what is alimony? It is a compensation given to the spouse at the time of divorce. This compensation can take two forms. Either it can be given as a one-time compensation, or it can be given as a monthly amount every month. If it is given monthly, then it is considered as a revenue receipt. And if it is a revenue receipt, it is considered as a income and it is taxed. If it is a revenue receipt, then that revenue receipt is treated as an income and the tax is levied. But if it is received as a one-time compensation, then it is in the nature of capital receipt, and anything which is capital receipt is generally not taxable. So alimony you can write here, monthly, or maybe you can write recurring is taxable. Monthly alimony, in the bracket you can write recurring in nature. If it is recurring in nature, it is taxable. Alimony which is recurring in nature, in the bracket you can write monthly, it is taxable. On the other hand, you can also write what? If it is capital in nature, it is a one-time compensation, it is not taxable. Now we are left with the last, capital receipt versus revenue receipt. Here two things are there. Number one, what is the meaning of capital receipt? What is the meaning of revenue receipt? I don't think that there is a need to explain what is capital receipt, what is revenue receipt. Do you want me to explain this? We will just discuss the taxability. We will discuss what? Taxability, whether the revenue receipts are taxable or whether the capital receipts are also taxable. capital receipts versus revenue receipt. See, capital receipt versus revenue receipt. Generally, you may think that revenue receipt is recurring in nature and capital receipt is non-recurring in nature. This is one of the parameters to decide whether a receipt is a capital receipt or revenue receipt. But in income tax, you can think slightly in a different manner. We say that any receipt from the source of income. For example, you have invested money in debentures. So you are earning what? You are earning interest. This interest which is earned on debentures is considered as income. And what is what? That will be called as a capital receipt. So capital receipt is what? Income for your source. Income for the source. So when you sell the source, when you transfer the source of your income, whatever amount you receive is called as what? It is called as capital receipt. So if you sell the debentures and you receive money, it will be considered as a capital receipt. But if you receive interest on debentures, it will be considered as revenue receipt. Is that very clear? Now, see, these things we'll discuss in future in much detail when we go on to discussion of different incomes taxability. Right now, we'll discuss in a very brief manner taxability of revenue receipt and capital receipt. Question number 1 is whether only the revenue receipt should be treated as income or even the capital receipts should be treated as income. Generally, what should happen? Generally, revenue receipts are considered as income. So, generally, revenue receipts are considered as income. And generally, capital receipts are not considered as income. Generally, revenue receipts are considered as income and capital receipts are not considered as income. Now, say for example, you want to charge tax on particular income. If government wants to charge tax on particular income, what government will do? Government will make which type of section? If government wants to levy tax on particular income, government will make which type of section? Charging section as well as machinery section. Government will make charging section as well as machinery section. Do you recollect this? Yes or no? So, revenue receipts are generally considered as income, and if government wants to charge tax on this income, government will make charging section as well as machinery section. Is that very clear? Okay. Now, but say for example, government doesn't want to levy tax on a particular revenue receipt. Government doesn't want to levy tax on a particular revenue receipt. But the question is, do you believe that every revenue receipt is an income? Yes. By default, all the revenue receipts are considered as income. So, if government is having an intention to levy tax on a particular revenue receipt, what government will have to do? government will have to make a charging section as well as a machinery section. And on the other hand, if government doesn't want to levy tax on a particular revenue receipt, government intends that on a particular revenue receipt we don't want tax, we don't want to levy the tax. In that case, government has to clearly specify that this revenue receipt is not considered as, this revenue receipt is income, but it is not taxable. And whenever government doesn't want to levy tax on any revenue receipt, government will make a separate category of section, separate type of section. Government will make a exemption section. Government will make a exemption section. Is that very clear? For example, there is section 10 clause 1. Section 10 clause 1 says what? Agricultural income earned in India is not taxable. Agricultural income earned in India is not taxable. So, if you want to conclude discussion of this revenue receipt in 2 lines, what do we say? Revenue receipts are generally considered as income. If government wants to levy the tax, they will make charging section as well as the machinery section. If they don't want to levy the tax, they will make a exemption section. So can I say it is mandatory for government to make a section for each and every revenue receipt? Either they will have to make a charging section and machinery section, or they will be required to make a exemption section. There should not be any revenue receipt for which there is no section in the Income Tax Act. Is that very clear? Let's move on to the last part, that is capital receipt. First of all, tell me generally, do you believe that capital receipt is income? Generally, we don't consider capital receipts as income. Since generally we don't consider capital receipts as income, generally these capital receipts are not taxable. Generally, capital receipts are not taxable. For example, government doesn't want to levy separate exemption section for saying that this capital receipt is not taxable. So generally, for a capital receipt, generally, see these things that we are discussing, generally, no exemption section will be available for this. Generally, no exemption section will be available. Now tell me, if government wants to levy tax on a capital receipt, what government will have to do? Government will have to make a charging section and machinery section. But before that, my question to you is, do you believe that a capital receipt is an income? No. If capital receipt is not an income, if it is not an income at all, how can you make a charging section for levying tax? If it is not an income, you cannot make a charging section and machinery section for levying the tax. So generally capital receipts are not considered as income, therefore they are not taxable. and there is no need to make a separate exemption section for saying that these incomes are or these capital receipts are not taxable. But the question is, if government wants to levy tax on a particular capital receipt, is there a need to make a charging section and machinery section? Answer is yes, there is a need. But just by making a charging section and machinery section, capital receipt cannot be taxed. Why? Because generally capital receipts are not an income at all. If something is not an income, where there is a question of taxing it. So for charging tax on a capital receipt, first of all, since capital receipt is not considered as income, government will have to make a section saying that these capital receipts are considered as income. So those capital receipts which are generally capital receipts are not considered as income. For that, for making a capital receipt as an income, government will have to make a section saying that following capital receipts would be considered as an income. Once government has made a section saying that these capital receipts are considered as income, only then a charging section and machinery section can be made for charging tax on a particular capital receipt. Have you understood this? So, for making a particular capital receipt as an income, what government is required to do? Government will put that capital receipt in the definition of income. In the definition of income, government will insert all the capital receipts on which they are having an intention to levy the tax. Once they put it in the definition of income, those particular capital receipts would be considered as income, and once they become income, government will make the charging section and machinery section for levying tax on those capital receipts. Is that very clear? So if government wants to levy tax on a capital receipt, what is the first step they are expected to do? They are expected to make that capital receipt as income. For that, what they will do? They will change the definition of income. They will include that particular capital receipt in the definition of income. So for that, they have to change the definition of income. Definition of income is given where? Section 2, clause 24. In this, they will include the capital receipt. Once they include the capital receipt in the definition of income, what will happen? That will be considered as income. And once that particular capital receipt is considered as an income, the next step for the government is to create a charging section and machinery section. So government will create the charging section, government will create the machinery section. And once the charging section as well as machinery section both are created, particular capital receipt will also become taxable. Is that very clear? Now before we have a break, let us conclude the entire discussion with respect to capital receipt, revenue receipt in not more than 3-4 sentences. Generally, revenue receipts are considered as income. True or false? Every one of you should answer. Generally, revenue receipts are considered as income. If government wants to levy tax on a particular revenue receipt, what government is expected to do? Make a charging section as well as the machinery section. And if the government doesn't have the intention of levying tax on a particular revenue receipt, what they will do? They will make a separate exemption section. Is that very clear? Generally, capital receipts are considered as income. True or false? False. Generally, capital receipts are not considered as income. Say, for example, for a particular capital receipt, nothing is mentioned in the Income Tax Act as to whether it is taxable or not taxable. Will it be taxable? No, it will not be taxable. So by default, all the capital receipts are generally not taxable because they are not considered as income. Now, if the government is having an intention of levying tax on a particular capital receipt, what is the step one for the government? To make that capital receipt as an income. For that, what they have to do? They have to change the definition of income and include that particular capital receipt in the definition of income. Once that capital receipt is inserted in the definition of income, that particular capital receipt would be considered as an income. Thereafter, for levying the tax, what they will have to do? They will have to make a charging section as well as the machinery section. Is that very, very clear? So with this, our discussion with respect to what? Definition of income comes to an end. So all the theoretical aspect in this chapter are over. After the break, we will move on to the calculation of tax liability. We will start from the same point where we left yesterday. Is that very clear? Now we will move on to the calculation of tax liability from the point which we had stopped yesterday. I will revise whatever we discussed yesterday with respect to calculation of income and tax, and then we will proceed further. Yesterday I told you that receipts can be divided into two parts. Number one, those receipts which are considered as income, and those receipts which are not considered as income. Yes or no? Okay. Once a particular receipt is considered as an income, focus here. How would you come to know whether a particular receipt is considered as an income or not? If it is a revenue receipt, by default it is an income, and if it is a capital receipt, then what? It is not an income, but if that capital receipt is inserted in the definition of income, it would be considered as an income. Is that very clear? So when we say that yes, particular receipt is an income, we mean to say that either it is a capital receipt or it is a revenue receipt which is covered by the definition of income. Now can you connect that discussion with this flowchart? Okay. So if a particular receipt is considered as an income, then comes the question whether that particular receipt is taxable or not. If it is not taxable, then we will not disclose anywhere in our income tax return. If it is taxable, then as per which section? As per section 14. As per section 14, we have to classify the taxable into how many heads of income? 5 heads of income. Those heads are income from, first head is what? Income from salaries. Second one is income from house property. Third one is profits and gains of business or profession. Fourth one is income from capital gains. And the fifth one is income from other sources. If you could recollect, income from salaries chapter, the section range is what? Section 15 to 17. And I also told you yesterday that in that range of section, the first section is always a charging section. So when it comes to the chapter of income from salaries, section 15 is the charging section. Second head of income is income from house property. The range of section is from 22 to 27, and the charging section is section 22. Similarly, for the head of profits and gains of business profession, the range of section is from 28 to section 44 dB, and the charging section would be section 28. For capital gain, section would start from 45, and the last section is 55A, and the charging section is definitely section 45. And the last one is income from other sources. The range of section is from 56 to 59, the charging section being section 56. This is what we had discussed yesterday. I also discussed with you the mechanism of computation of income. Mechanism means procedure of computation of income. In each head of income, the mechanism of calculation of income is nothing but gross income less deduction net income. Gross income means income before deducting any expense. All the expenditure which you have incurred for earning the income, those expenditure are deducted while computing your income. Therefore, they are termed as deductions. In income tax, we don't say it as expense, we call it as deductions. So from gross income, you deduct the amount of expenditure incurred, that will be called as deductions, and the balance amount of income is called as net income. For each head of income, we'll have to make a statement of income. So we'll be having how many amounts of net income? 5 amounts of net income. If you add up all those 5 amounts, the amount which is arrived will be termed as what? Gross total income. From that gross total income, once again you deduct the deduction which are given in chapter 6a, starting from section 80C and ending at section 80U. Once you deduct the amount of deductions in section 80C to 80U, the amount which is arrived will be called as total income. See, total income is the word which is used in the Income Tax Act. You may call it as taxable income or net taxable income, but income tax uses the word total income. As per section 4, charging section of Income Tax Act, what is chargeable to tax is total income. On this total income, tax liability will be ascertained. Is that very clear? Now, I need to discuss two sections with you. I will be discussing two sections at the same time. The first one is section 288A. This A is not subsection, it is section only. Section 288A, and the second one is section 288B. The content of both the section is same. Content of both the section is same. Section 288A talks about rounding of the total income. Rounding off means if your income is, say for example, 55,55,555 rupees and 55 paise. So we need to do the round off, whether that anything appearing after decimal should that be taken into account or should it not be taken into account. All these things are mentioned where? In section 288A and section 288B. Section 288A talks about the provisions with respect to rounding of what? Rounding of the total income. And section 288B talks about the provisions with respect to the rounding of the tax liability. Let me tell you that both the sections are replica of each other. The only change is 288A is talking about the rounding of the total income and 288B is talking about the rounding of the tax liability. So these sections include the rules with respect to rounding off. Generally, if you have scored, say for example, 59.6% in your examination, you would say that you have scored a first class, you have scored more than, you have scored 60%. So by default, what you are doing, 59.6, you are rounding up to 60. Similarly, in income tax also, there are certain rules for rounding of your total income as well as for rounding of the tax liability. So let us try to understand what are the rules. First of all, you need to pick up the amount of total income. Anything appearing after the decimal, this point in paise, this should be totally ignored. This should be totally ignored. And the number, you have to look at the last digit. First of all, step number 1 is what? Anything appearing after the decimal should be totally ignored. Even if it is 90, that should be totally ignored. So anything appearing after point, anything appearing in paise, whether it is 40 or 90, it is not relevant, it should be totally ignored. And then before the decimal, you look at the last digit. If that last digit is 5 or more, last digit is how much? 5 or more, then you round off the total income as well as tax liability to the nearest multiple of 10 rupees. Nearest multiple of 10 rupees. So income and tax liability should not be rounded off to nearest multiple of 100 rupees. It should be rounded off to nearest multiple of 10 rupees. So in this case, your total income is say 55,55,555 rupees. So what is the last digit here? Last digit is 5. So when the last digit is 5 or more, you round off the income to the next multiple. Next multiple means go ahead. Next multiple of 10 rupees. In that case, your income will be how much? 55,55,560 rupees. 560 rupees. Is that 100% clear? See, these rules are being discussed for the first time and the last time in your entire life. In this basic concept chapter, tax liability calculation is done for the first time and the last time. Whenever in the further chapters, question is asking you to calculate the income as well as tax liability, I will help you to calculate the income. Tax liability you will have to calculate on your own. So moral of the story is, if you have any iota of doubt, a smallest of the doubts you should ask. Is that 100% clear? Yes, last bench. If the last digit is 5 or more, you round up to the next multiple of 10 rupees. What if the last digit is less than 5? Then also you have to round off. What do you have to round off to the previous multiple of 10 rupees. In that case, your income will be 55,55,550 rupees. Is that very, very clear? So your income has to be in multiple of 10 rupees. It can be either 50, 60, 70, etc. Yes, is that very clear? So the rules for rounding of the total income are given in section 288A, and rules for rounding of the tax liability are given in section 288B. Rules are 100% same. Examiner will not ask you to round off. By default, you have to round off. Is that very clear? So it is implied that you have to round off the total income. You also have to round off the tax liability. Examiner specifically will not ask you to round off anything. Yesterday we also discussed that the calculation of tax liability is a 3-tier system or a 3-step system. First of all, you have to calculate what? You have to calculate the basic tax. This basic tax is calculated on what? It is calculated on total income. So step 1 is calculation of basic tax. Basic tax is always calculated on total income. Once you have calculated the basic tax, then you move on to step number 2 and calculate surcharge. Surcharge is also called as super rich tax. Super rich tax means only people who are earning heavy amount of income. For example, beyond an income of, if you are earning income beyond 50 lakhs, then only you have to pay surcharge. So surcharge is not levied on everyone. It is levied only on those people who are earning very high amount of income. So surcharge is what? Surcharge is calculated on what amount? Is it calculated on the amount of income, or it is calculated on the amount of basic tax? It is calculated on the amount of basic tax. So surcharge is not tax on income, it is tax on tax. Once you have calculated step number 1 and step number 2, you have to take the total of both. So you will arrive at the amount of basic tax plus surcharge. And then finally you move on to step number 3, that is calculation of cess. Calculation of which cess? Health and education cess. See, whatever government collects by way of cess will be utilized for that particular purpose. In this case, government is levying health cess and education cess. So this money which is collected in the form of health and education cess will be utilized only for the purpose of health expenditure and the education expenditure, because specifically it is collected with that objective in mind. Is that very clear? This health and education cess will be calculated on what amount? It will be calculated on the amount of basic tax plus surcharge. Is that very, very clear? So today we have discussed section 288A and section 288B, rounding of the total income and rounding of the tax liability. So I move on to your textbook, page number 12. We already have discussed category 1, category 2 and category 3. We have also discussed that in budget 2020, government has introduced a new section, section 115 BAC. Is it mandatory for a person to go for section 115 BAC? Section 115 BAC is applicable in case of which person? Only individual and HUF. It is not applicable in case of firm, company, etc. It is applicable in case of individual and HUF. Do you believe that you are having separate slab rates for senior citizen and non-senior citizen? No, it is same for everyone, whether you are resident or non-resident, whether you are senior citizen, whether you are a non-senior citizen. Slab rates are same for everyone. If you want to go for section 115 BAC, what is the important condition? You have to sacrifice what? Certain exemption and deductions. If you are not ready to compromise with exemption and deductions, then you can't go for section 115 BAC. Which are those exemptions and deductions which are required to be sacrificed? That we'll discuss in the last chapter, that is chapter number 16. As of now, I have just explained you that there is something called a section 115 BAC, wherein the slab rates are different as well as the tax rates are different. Now we have yesterday we have completed the calculation of tax liability for those people who are falling into category 1, category 2 and category 3. The further part we need to discuss, but before we discuss the further part, let me get into the, do one thing, we will discuss the basic tax rate for everyone first. Category 4. Who all are covered by category 4? Firm. What do you mean by firm? LLP as well as traditional partnership firm. Besides firm, who is covered by category 4? Local authority is also covered by category 4. So every firm and every local authority, their income is taxable at flat rate of 30%. In other words, they don't have progressive taxation, they have fixed taxation system, wherein the entire income will be taxed at a particular rate. What is that rate? 30%. So if their income increases, their tax rate is not going to increase, their tax rate is going to remain the same. Even if they have earned an income of 100 rupees, they have to pay tax at same rate of tax. Is that very clear? So a partnership firm including limited liability partnership as well as local authority, their income is taxable at flat rate. Flat rate of what? 30%. Number 5, cooperative society. Fifth category is cooperative society. Before we move on to this, my question to you is, cooperative society falls into which point number of the definition of person? Cooperative society is covered by which point? What is point number 5? Association of person or body of individual, whether incorporated or not. So only one category of association of person, that is cooperative society, is separately covered in point number 5. Other than cooperative society, if you have any other association of person, then what? Then you are covered by category 1. Is that very clear? So here also in category 1 we have written association of person or body of individual except the cooperative society. Yes, is that very clear? Tell me, what is the first slab of income for cooperative society? 10,000. Up to 10,000 income will be taxed at 10%. In other words, in case of cooperative society, there is nothing called as basic exemption limit. Their basic exemption limit is 0. Is that very clear? See, for you, what is part of your syllabus is calculation of tax. Income of a cooperative society is up to 10,000 rupees, then the tax will be levied at 10%. If the income reaches beyond 10,000, but if it is up to 20,000, then it will be taxed at 20%. So my question is, if the income of a cooperative society is 20,000 rupees, what will be tax liability? Will you apply 20% rate on the entire amount of 20,000? No, here also you have to apply slab wise. So on first 10,000 you apply 10%, that amount will be 1,000. On the next 10,000 you apply 20%, that amount will be 2,000. In other words, if the income reaches beyond 20,000, what is the amount of fixed tax which the cooperative society is liable to pay? 3,000 rupees. 3,000 rupees. Is that 100% clear? Yes or no, each one of you? If the income is beyond 20,000, whatever amount of income is beyond 20,000 will be taxed at what rate? 30%. Will be taxed at 30%. Now there is one section which is mentioned this time onwards in ICI module, and they have clearly written in the module itself that this section will be discussed with you in detail at CA final level. I do not know why such kind of sections are even given in the ICI module at intermediate level. There is no need to give such sections, but since CA Institute has covered in the basic concept chapter, we have also inserted here in the notes. There is one section, section 115 BAD. Section 115 BAD, which you will be learning in CA final. This section says that if the cooperative society doesn't want to pay tax at the slab rates, instead of that, they can go in section 115 BAD and they can pay tax at the rate of 20% on the entire income. So instead of slab rates, they can pay tax at flat rate of how much? 25%, but 22%. But this section is also an optional section similar to section 115 BS. So this is the optional tax regime. The cooperative society has to decide whether they want to pay tax at slab rates or whether they want to get into section 115 BAD and pay the tax at flat rate of 20%. If they decide, so this option is available to which kind of cooperative society? Only those who are resident in India. In other words, non-resident cooperative society has to pay tax at slab rates only. They don't have the option to get into section 115 BAD. Is that very clear? So a resident cooperative society opting for section 115 BAD. Opting means they have the right to select which option they want to go for. If they opt for section 115 BAD, then the tax rate would be 22%. And they will have to compulsorily pay surcharge at the rate of 10%. I have not explained you surcharge in detail. I have just told you that surcharge is nothing but tax on tax. It is tax levied on a super rich person who has earned income anywhere beyond 50 lakhs. But in this case, if the resident cooperative society opts for section 115 BAD, then irrespective of income, they will have to pay the surcharge. Whatever may be the level of income, whatever may be the amount of income, surcharge will be levied on a compulsory basis. At what rate? At the rate of 10%. 10% of what? 10% of surcharge is levied on what? Basic tax, not on the amount of total income. So, first of all, on the amount of total income, you have to calculate basic tax at the rate of 22%, and then on the amount of that basic tax, you calculate surcharge at 10%. If you go for section 115 BAD, it is mandatory for you to pay the surcharge. So here we have a compulsory rate of surcharge at the rate of 10%. Is that very clear? This will be discussed in detail at CA final level, which all cooperative societies have a right to get into these sections. There are certain conditions. Every cooperative society cannot get into this section. Now we move on to the last part, that is the tax rates in case of companies. Tax rate in case of companies. Can you tell me, you can classify companies into how many categories? The first one being Indian company. What do you mean by Indian company? Incorporated in India. Second one is foreign company, which is registered outside India. And the third one is domestic company. Domestic company means which company? Domestic company means a company which may be registered outside India, but they are having some shareholders in India and they have made the arrangement for payment of dividend to those shareholders in India. Such foreign companies will be called as domestic companies. Now, one more question arises in my mind is whether the Indian company would be considered as domestic company? Definitely, Indian companies are always considered as domestic company. So my question to you is, which term is a wider term? Indian company is a wider term or a domestic company is a wider term? Domestic company is a wider term. It will include an Indian company as well as a non-Indian company which is registered outside India, having shareholders in India, and they are paying dividend to the Indian shareholders. Is that very, very clear? So the tax rates, when it comes to tax rates, they have not told that falling in the tax rates for Indian company, they have used the word domestic company. So what are the tax rates for domestic company? For the purpose of tax rates, they have divided the company into two. Number one, domestic company, and number two, other than domestic company. Other than domestic company, in other words, they are foreign companies. So domestic company, we have different rates of tax. There are multiple sections. Here I have put a asterisk mark saying that these three sections will be discussed with you in detail at CA final level. Forget about these three sections here. You just remember these 2 points, first and second. What is the normal rate of tax in case of domestic companies? 30%, 30. And this is a flat rate of tax. So slab rate is not applicable in which was, if the company is having be decided in 2021. If your turnover in the year 18-19 was not exceeding 400 crores, then your total income in the current year, that is previous year 2021, would be taxed at 25%. Now a natural question would come in your mind, why they are looking at the turnover of 2 years back? Why can't they look at the turnover of current year? See, if they decide the tax rate, if they say the tax rate will be say 25%, if the turnover is less than 400 crores in the current year, then what will happen? Company will have a chance to manipulate the accounts and reduce the turnover. But in that way, they can even manipulate the accounts of the year last to last year. 2 years back, accounts also can be manipulated, na? Can it be manipulated? Or it can't be manipulated? It can't be manipulated. Why so? Because those books of accounts might have been already audited by a chartered accountant. Once the books of accounts are audited, the sales turnover figures are already freezed. Then it is impossible for the company to go back and change the entries and manipulate the accounts. That is the reason government has not spoken about the current year or the immediately prior year. The immediately prior year also you can manipulate the turnover because the books of accounts are not yet audited. So keeping in mind this point, there should not be any scope of manipulation. If your turnover is 401 crore, you will make some changes in the books of accounts and you will ensure that the turnover falls below 400 crore. So that you save tax at the rate of 5%. Instead of 30%, you pay tax at 25%. So government doesn't want to keep any chances of manipulation. Therefore, government says you look at the turnover which is prior to 2 years back. Correct? So you look at the turnover of the year 18-19. If the turnover of the year 18-19 is less than equal to 400 crores, when we say it does not exceed 400 crores, means it is either less than 400 crores or it is equal to 400 crores. In that case, your current year's income will be taxable at flat rate of 25%. In other and if you fall into any of these sections, then the rate of tax would be a concessional rate of tax, lower rate of tax. Do you recollect now I'll give you 1 minute's time. You refer this point number B. You refer this point number B. Point number B is applicable in case of which companies? Foreign companies. Foreign companies. Refer this point number B1 and B2. Yes, have you referred? So point number B1 is covering all income or specific income. What is that income? Royalty income, that too earned as per the agreement entered with the government of India. And that too if the agreement is entered during a particular period. So if any company, if any foreign company is earning an income of royalty or fees for technical services, and this income they are receiving from whom? They are receiving from government of India or any Indian concern, means Indian company. They have entered into an agreement with government of India between 1st March 1964 to 30th March 1976 in case of fees for technical services, and between 1st April 1961 to 31st March 1976 in case of royalty. In that case, that royalty and fees for technical services income would be taxable at 50%. Would be taxable at 50%. See, this is not relevant for the examination. You need not remember these things. This is very past old information which is not generally asked in the examination. So if I ask you what is the tax rate of foreign companies, then you should say that the tax rate of foreign companies is 40%. Definitely to foreign company we should levy a tax at a rate which is higher as compared to the domestic companies. So here we have completed the discussion with respect to what? With respect to the calculation of basic tax. Calculation of basic tax. Now right now I'll not get into the surcharge, but I'll just ask you a very simple question from this table you have to answer. Refer to this table and answer. Surcharge is levied when? Surcharge is levied under what circumstance? Only when your income is beyond a particular level. So referring to this table, can you tell me your income should be minimum how much to levy the surcharge? It should be at least 50 lakhs. So if your income is less than or equal to 50 lakhs, you can't think of surcharge. Is that very clear? So as of now, I am skipping this surcharge as of now. Health and education cess, we have already discussed that it is levied in all cases. Health and education cess it is levied at what rate? 4%. 4% of what? Basic tax plus surcharge. Health and education cess is levied in case of individual or HUF, or it is levied in case of all persons. It is levied in case of all persons. It is levied in case of person earning lower income or higher income or any income. Any income. So health and education cess is levied irrespective of the level of income and irrespective of nature of person. Is that very clear? Section 288A, 288B I have already discussed with you. Now we'll move on to question number 3. Before we move on to question number 3 talks about the calculation of tax liability. If the examiner is asking you to calculate the tax liability, what does that mean? Is he asking you to calculate only the basic tax, or he is asking you to calculate the final amount of tax? Final amount of tax means what? After adding the health and education cess. Yes or no? Now you know that in case of individual and HUF, we have a new section which is inserted in budget 2020, that is section 115 BAC. Very important point to be noted is, if the examiner doesn't tell you here, that will not discuss. Tax liability in following 6 cases. First case says that the age of Harish Patel is 35 years and he is resident in India. He is covered by which category? He is covered by category 1. What is the fixed amount of tax liability if your income is 5 lakhs, 12,500? So here, without using the calculator, you will calculate tax on what amount? Only on 3 lakhs. At what rate? 20%. So 20% of 3 lakh is how much? 60,000. To that you will add how much? 12,500. So that is how much? 72,500. Have you all understood this calculation? There will not be any surcharge. Yes, definitely. We will go step by step. So you have arrived at the amount of 72,500. Now you will apply this cess at the rate of 4%. So that will get you the amount of 75,400. Every one of you have understood very clearly? Yes or no? Yes, this side last bench. Madam? 75,400. So in case A, tax liability is 75,400. Please don't think that such kind of question will be asked in the examination. It is only for practice purpose. Case B. In case B, what is the age? 35 years and he is non-resident. If the age is less than 60, then irrespective of whether an individual is resident or non-resident, he falls into which category? Category 1 only. In other words, in this case, the tax liability would remain the same. Say yes or no? So in second case also, the tax liability is 75,400. Shall I proceed? Okay. Third case says that his age is 65 years and he is resident in India. If his age is 65 years and he is resident in India, means he falls into which category? Second category. In second category, the basic exemption limit is how much? 3 lakh rupees. So if his income is 5 lakh, what will be the fixed amount of tax liability? 10,000 rupees. 10,000 rupees. So you will actually calculate tax only on 3 lakhs at what rate? 20%. 20% of 3 lakh is 60,000. To that you will add what amount? 10,000 rupees. So what is total amount? 70,000. To that at 70,000 you will add what? 4% education cess. So 4% of 70,000 is 2,800. So the final tax liability is 72,800. Is that 100% clear? Yes, madam sitting on the last bench. Call her. What is her name? Have you understood this? I am asking you. Yes. So here what is the amount? 72,800. 72,800. Fourth case. His age is 65 years and he is non-resident in India. In that case, he is covered by first category. So, amount of tax liability would remain the same. That is how much? 75,400. See, these questions are made to make you understand which person will fall into category 1, 2 and 3. Let's move on to case E. Case E says that his age is 85 years and he is resident in India. So he falls into category 3. His basic exemption limit would be 5 lakhs. So we will calculate tax at 20% on the amount of 3 lakhs, which is 60,000 rupees. On that 60,000, you will apply the cess at the rate of 4%, which is 2,400. So your total tax liability would be 62,400. Are you understanding, or do you want me to write and explain you? You are understanding, right? So in this case number E, case number 5, your tax liability is how much? 62,400. Now let's move on to the last one, which says that his age is 85 years and he is non-resident in India. In that case, he is covered by first category. So his tax liability would remain the same, that is 75,400. Have you understood this very, very clearly? Yes. So the objective of this question was to make you understand when an individual will fall into category 1, when he will fall into category 2, and when he will fall into category 3. Now we have few small topics in this chapter. The next section is section 87A. Which is the next section? Section 87A. Listen to me very carefully. Generally in the examination, while calculating the tax liability, students tend to forget this section. The way I told you that examiner will not specifically instruct you to calculate the surcharge. He will not specifically instruct you to apply the cess. It is implied that you have to calculate the final tax liability. If surcharge is applicable, you calculate. Cess is always applicable. Rounding of the total income, rounding of the tax liability, specific instruction will not be given to you. It is implied that you have to round off. Similarly, section 87A, if the provisions of this section are applicable, you have to apply the provisions. Examiner is not going to give you a specific instruction for it. Is that very clear? So, section 87A says that we are going to offer some rebate. We are going to offer some rebate. What do you mean by rebate? Rebate, the word rebate you might have heard for the first time in bookkeeping and accountancy, bill of exchange chapter. Rebate is nothing but discount. Whenever the drawee pays the amount against the bill before the due date, the drawer would offer a rebate to the drawee. So rebate is nothing but a discount. So here government has come out with a discount scheme wherein government says those people who are falling into lower middle class category, we will offer them a discount. Discount from what? Discount from tax liability. Discount from tax liability. So from the basic tax liability, a discount is offered. Discount is offered to whom? Only to those people who are falling into lower middle class category. So first of all, the word rebate indicates what? It is a discount. It is a discount offered to you by the government from the tax liability. First important thing is discount is offered only to individuals. In other words, this section is not applicable in case of HUF, firm, company, etc. It is applicable only in case of individual. So this is condition number 1. Condition number 2, discount is offered to individual. Listen to me very carefully, even if you know the provision. Discount is offered to individual only to those individuals who are resident in India. In other words, if an individual is non-resident, he will not be offered any discount in section 87A. Discount is offered only if an individual is resident in India. So first condition is SSE should be individual, and second condition is SSE should be a resident individual. Third point, government says that resident individual should be into which category? He should fall into economically lower middle class category. Therefore, government has put up a criteria that if your total income is less than or equal to 5 lakhs, we believe that you are into a lower middle class category. Only then we will offer you a discount. So, for rebate under section 87, how many conditions are required to be fulfilled? 3 conditions. All of them are required to be fulfilled, or any one of them? All of them. First condition is SSE should be individual. Second condition, he should be resident in India. And the third condition is his total income should be less than equal to 5 lakhs. My question is, in the last question we did not calculate the rebate. Why? Because the income was 8 lakhs. Rebate is available only if your total income is less than or equal to 5 lakhs. So there are 3 conditions which are required to be fulfilled. Once these 3 conditions are fulfilled, you have to quantify the amount of rebate. You have to quantify the amount of rebate. Now, very important point is, you will have to calculate the rebate when? After adding the health and education cess, or before adding the health and education cess. So government says you calculate the rebate, or you deduct the amount of discount, you deduct the amount of rebate before adding health and education cess. They have used that language in the provision. So your rebate will be how much? Your rebate will be lower of following 2 amounts. See, whenever this government is offering you some deduction, rebate or exemption, they are going to calculate 2-3 amounts and they will select lower out of them, so that your exemption, rebate, deduction, etc. is less and your income is more. But if government wants to levy a tax, then in that case they may calculate 2-3 amounts, and out of those 2-3 amounts they would select whichever is higher, so that they get more amount of taxes. This is the tendency in most of the provisions. So here we say that rebate is lower of following 2 amounts. Amount number 1 is 100% of your tax liability excluding health and education cess. This words excluding health and education cess indicates that the rebate is required to be calculated before adding education cess. Yes, is that very clear? So first of all, you calculate 100% of your tax liability. 100% of which tax liability? Definitely basic tax liability. And then you compare that with 12,500. Out of the both amount, whichever is lower would be considered as the amount of rebate. This amount of rebate should be deducted from the amount of your basic tax liability. And thereafter, on the balance amount, you should apply the health and education cess at 4%. Is that very, very clear? Yes or no? Yes? One more time. Rebate will be how much? First of all, when you will calculate the rebate, at what stage? After the calculation of basic tax. Have you understood the meaning? Have you understood the conditions? Okay. So, you have to calculate the rebate. For that, there are 2 amounts. Amount number 1, you calculate 100% of your basic tax. Whatever is the amount of your basic tax, multiply by 100%. Basically, that same amount of basic tax. Yes. Then, you write amount number 2, and the amount number 2 is fixed at 12,500 rupees. Why it is fixed at 12,500? You will realize in next span of 1 minute time. But you write amount number 2, that is 12,500. Out of the first and the second amount, you select whichever is lower. You select whichever is lower. That would be considered as the amount of rebate. That would be I'll take up the amounts. I have 3-4 different cases also to make you understand. But have you understood the procedure? Numbers will take and understand. Right now, we should just understand the procedure. We'll solve the question. I have a specific question on that. Before we move on to that question, I'll ask you a very simple question. Whether surcharge and rebate can come at the same. There are certain incomes which are taxable at average rate. Those are not there in your syllabus. But you need to know that this is the manner in which you have to calculate your average rate. Next is maximum marginal rate of tax. This is called as what? MMR rate. there are certain incomes which are taxable at maximum marginal rate. Maximum marginal rate is also a rate of tax. See, we have different rates of tax. We have slab rates of tax, we have fixed rate of tax, we have something called as average rate of tax, and we have maximum marginal rate of tax. In certain cases, in case of certain persons, certain incomes are taxable at maximum marginal rate of tax. Those will be discussed with you at CA final level. There is a chapter called as assessment of public, charitable and religious trust. There, certain incomes are taxable at maximum marginal rate of tax. But we need to understand what do you mean by maximum marginal rate of tax. I will explain you what is maximum marginal rate of tax, and you will have to calculate on our own and tell me what is the maximum marginal rate. Maximum marginal rate of tax is nothing but, before that tell me, in case of individual, this is the table of surcharge. This is the table of surcharge. My question to you is, in case of individual, what is the highest surcharge rate? 37%. Highest rate of surcharge applicable in case of individual, HUF, etc. is 37%. Is that very clear? Acha. Now, maximum marginal rate, the meaning says, maximum marginal rate means the highest slab rate applicable to individual. What is the highest slab rate applicable to individual? 30%. Plus to that, highest surcharge rate applicable to individual. Surcharge is calculated on what? Basic tax. So you apply that 37% on that 30%. You apply 37% on what? On 30%. So you take the highest slab rate, you take the highest surcharge rate, and you take the health and education cess at 4%. The amount which is arrived finally is called as maximum marginal rate of tax. You can calculate in your calculators. First of all, you take the highest slab rate. What is that? 30%. Now you calculate 37% of 30%. 37% of 30% is how much? 11.1. So you add 11.1 to 30%. So 30 plus 11.1 is 41.1%. Have you understood? To that 41.1%, you add a 4% health and education cess, you would arrive at the rate of 42.744%. Is that very clear? This 42.744% is called as what? Maximum marginal rate of tax. We call it as MMR, maximum marginal rate of tax. There are certain incomes which are taxable at this rate. Which are those incomes? Those will be discussed at CFI. Have you understood this very clearly? Okay. Now, very important section which you covered right now was section 87A. 87A talks about what? Rebate. So we'll move on to question number 5 and we'll calculate the tax liability. Compute the tax liability of Mrs. Asha Kulkarni, aged 35 years, in each of the following situations. In each of the following situations. Still, we calculate in the format only. See, this is a simple, very simple format, tabular format. Question number 5, case number A. Case number A. See, please calculate step by step. See whether the conditions are fulfilled or not. Then only you apply the rebate. Case A, what is the residential status? Resident in India. Resident in India. Yes or no? And what is the total income? 4,50,000. So can I say she is individual? Covered by which category? First category. If an individual is covered by first category, the basic exemption limit applicable to him is 2,50,000. So up to 2,50,000, there won't be any tax. And what is the amount of income beyond 2,50,000? 2 lakhs in this case. On that 2 lakhs, we will calculate tax at what rate? 5%. What is the amount of tax? 10,000 rupees. Yes or no? You have to apply 5%, right? So first of all, step number 1 is to calculate the basic tax. Now, whether surcharge is applicable in this case? No surcharge because income is not more than 50 lakhs. Whether the rebate is applicable in this case? Condition 1, whether she is individual? Yes. Condition 2, whether she is resident in India? Yes. Condition 3, whether her income, total income is less than equal to 5 lakhs? Yes. All the three conditions are fulfilled. So rebate under section 87 is required to be calculated. Yes or no? Okay. Rebate under section 87A is lower of following two amounts. What is amount number 1? 100% of tax liability. And amount number 2 is 12,500. Whichever is lower. So now you tell me what is 100% of tax liability in this case? 10,000 rupees. What is the maximum rebate? 12,500. What is lower out of these two? 10,000. So out of these two, lower amount is 10,000. This 10,000 is offered to you as a rebate. It is offered to you as a discount. Your tax liability is 10,000. Your rebate is also 10,000. So what is the balance tax after rebate? 0. If the balance tax after rebate is 0, then cess is also 0, and the final tax liability will also be 0. Your average rate of tax will also be 0. 2.96. So 2.96 is average rate of. Have you all understood this very clearly? Say yes or no. See, in this subject there are only two possibilities. Either you can understand 100% or you have not understood at all. If you say that I have understood partly, the conclusion is you have not understood. So your answers would be correct only if you understand the provisions in entirety. If you have doubt, please do ask, don't hesitate. And don't look at me in doubt. If you have any doubt, ask the doubts. Shall I proceed? Yes, this side. Let's move to the last case. Total income is less than equal to 4,50,000. Will you get a rebate? No, why? Non-resident. Rebate is eligible only when the individual is resident. So rebate is not eligible, rebate is not available. What will be the tax liability in this case? She falls into which category? Category 1. So tax will be calculated on the income of 2 lakhs. At what rate? 5%. That amount will be 10,000 rupees. See, if you want to write, you can write here in case number 3. Below that, case number 3, you can write no rebate because total income is more than 5 lakhs. In case number 4, you can write no rebate. Why? Because SSC is non-resident. So your tax will be 10,000 plus 4% cess on that will be 400 rupees. So your final tax liability is 10,400. 2.31% would be average tax rate. Yes, have you understood this very clearly? Madam, now you have understood? I am asking you. Okay. So with this, question number 5 is over. Our discussion with respect to calculation of rebate under section 87 is over. Very important point to be noted is examiner is not going to give you instructions that you have to calculate the rebate. Every time whenever the 3 conditions are fulfilled, by default you have to calculate the rebate. Is that very clear? Now in this chapter we had 5 questions. Out of 5 questions, 4 questions are over. We are left with only 1 question, and along with that our discussion is pending only with respect to surcharge. Only with respect to surcharge. Rate of surcharge is given to you on page number 14. So move on to page number 14 in your textbook. You will have to refer the surcharge table twice or thrice, otherwise you will not remember the rate. So first of all, let us try to understand when the surcharge is applicable, what is the rate of surcharge, and then we'll move on to something called as marginal relief. Marginal relief. I have already told you that surcharge is applicable only in case of super rich persons. Super rich person means they are earning an income which is very high, generally more than 50 lakhs. But in case of different persons, the level of income is different. For the purpose of calculation of basic tax, we had classified the persons into different categories. In all, we had how many categories? In all, we had 6 categories. For the purpose of calculation of basic tax, we had classified persons into 6 different categories. Similarly, for the purpose of understanding the rate of surcharge, we are classifying the persons into 4 categories. Who all are covered by first category? Individual, HUF, AOPBOI, and artificial juridical person. But the point is, which individuals are covered here? Resident individual or non-resident individual? Both. So irrespective of the age of individual, irrespective of the residential status of individual, rate of surcharge is same for everyone. Is that very, very clear? So in case of individual, HUF, AOP, VUI, an artificial juridical person, surcharge is applicable only when the income is beyond 50 lakhs. So if your income is up to 50 lakh, the surcharge is 0%, there is no surcharge. If your income is beyond 50 lakhs, but if it is up to 1 crore, less than equal to 1 crore, then the surcharge is 10%. 10% of what? 10% of basic tax. Now, listen to me very carefully. For example, if I ask you that your total income is 51 lakhs, your total income is 51 lakhs, whether surcharge will be applicable? Definitely yes, it will be applicable. Now you tell me, on a 51 lakh amount of total income, what will be the amount of basic tax? If you are a individual falling into first category, then if your total income is 51 lakh, what will be the amount of basic tax? You know that up to an income of 10 lakh, your tax is 1,12,500. Yes or no? What is the income beyond 10 lakh? 41 lakhs. On that 41 lakh, you apply the rate of tax of 30%. So you will get what amount? 12 lakhs 30,000. To that 12 lakhs 30, are you all understanding? To that 12 lakhs 30,000, you add the amount of 1,12,500. 13 lakh 42,500. 13 lakh 42,500 is the basic tax. Any one of you having doubt in this amount? 13 lakh? Madam, have you understood? No. You forget about this table as of now. I am just telling you, if your total income is 51 lakh, what will be the tax liability, basic tax liability? You pick up the calculator, you type 51 lakh. From that, deduct the amount of 10 lakhs. What is the balance amount left? 41 lakh. On that 41 lakh, you apply the rate of tax of 30% into 30%. What is the amount derived? 12 lakh? 12 lakh 30,000. To that, you add the amount of 1,12,500. What is 1,12,500? Tax liability on the income of 10 lakhs. Do you remember that? This is the table of surcharge. Do you want me to calculate? Okay. 1 second. See, can you tell me what is the tax liability? What will be the amount of tax liability if your income is 10 lakh rupees? 1,12,500. Are you sure about that amount, or you are having doubt in that also? Okay. So whenever you have to calculate the tax liability, you should not calculate the tax liability by splitting that amount into 4 slices, etc., because that is going to consume a lot of time. So whenever you have to calculate the tax liability, the moment you know that your income is beyond 10 lakhs, you bifurcate your income in 2 parts. First 10 lakhs and balance. What is balance? 10 lakhs and 41 lakhs. Now on this 41 lakh, you apply tax at 30%. That will be how much? 12 lakh? 12 lakhs 30,000. On an income of 10 lakh, you know that the tax liability is 1,12,500. Yes or no? Now we add up both the amounts. 13 lakhs 42,500 This is the amount of basic tax. Is that very clear? If you have any doubt, please do ask, because the moment I proceed further, you will not understand anything. The moment doubt comes in your mind, if it is not clear, if anything is not clear, it is your duty to ensure that you are asking. There is no need to be afraid here. You are not in a batch of 500 students. You are in a very small batch. You should ask. I don't mind writing and explaining you. If you are understanding without writing, I will explain without writing. If you want me to take the examples, definitely, if already I have the practical question, I may not take the example. Otherwise, I will take. Have you understood this? Okay. Now, you tell me, what is the tax liability in case your income is 51 lakhs? 13 lakh 42,500. Is that 100% clear? Now, I told you that surcharge is applicable only when the income is beyond 50 lakhs. Yes or no? Okay. Now, if I ask you, what is the tax liability? Right now, you calculated the tax liability of 13 lakh 42,500. Yes or no? Now, if I ask you to listen to me very carefully, if I ask you to give me the amount of tax in two parts, if I ask you to give me the amount of tax in two parts, your income is how much? 51 lakhs, correct? Now, if I ask you to give me the amount of tax in two parts, what is the amount of tax on 50 lakhs and what is the amount of tax on remaining 1 lakh? Have you understood the question? I took an example wherein I told you that your income is 51 lakhs. Yes or no? On 51 lakh, you told me that the tax liability is how much? 13 lakh 42,500. Yes or no? If your income is 51 lakhs, then your tax liability is 13 lakh 42,500. I don't think you are having any doubt here. Now, I want you to give me the amount of tax in two parts. I am bifurcating the income in two parts. Part 1 is 50 lakhs and part 2 is 1 lakh. Yes? Shall we restart? Okay. Do you recollect the example? We had calculated the tax liability on what amount? What amount of income? Okay. So if your income is beyond 1 crore up to 2 crore, your say surcharge rate will be how much? 15% of what? 15% of basic tax. The rate of surcharge is always required to be applied on the amount of basic tax. If the income is beyond 2 crores, if it is up to 5 crores, then the rate of surcharge would be 25% of basic tax. And if your income reaches beyond 5 crores, then the rate of surcharge is 37% of basic tax. Once the income is beyond 5 crores, the rate of surcharge would remain the same. Is that very, very clear? So in case of individual HUF, AOP, BOI, and artificial juridical person, we have how many rates of surcharge? How many different rates of surcharge? 4 rates of surcharge. The first one is 10, then it is 15, then it is 25, and the last one is 37%. Is that very clear? Okay. Now let's move on to the second category of persons. Who all are covered in second category? Cooperative society, firm, local authority. Whether the word firm will include the limited liability partnership? Definitely yes. If you want to write, you can write here. It includes LLP. The word firm always includes the word LLP. So these are the artificial persons. In this case, the surcharge would be applicable only when the income is beyond 1 crore. So the cooperative society, firm and local authority would be considered as a super rich only when their total income exceeds 1 crore. So in their case, it is not the limit of 50 lakh, it is the limit of 1 crore, and they have to pay a flat rate of surcharge at the rate of 12%. So in their case, the rate of surcharge is same everywhere. Whatever is the level of income, surcharge rate would remain the same, but the surcharge would be applicable only when the income is beyond 1 crore. Is that very, very clear? Let's move on to the third and the fourth category. Third category would cover the domestic companies, and the fourth category would cover other than domestic companies. When we say other than domestic companies, it is nothing but foreign companies. Now, see, in case of domestic companies, government has kept the tax rate on the lower side. They have a lower rate of tax. Their basic tax rate is 30%, or if the turnover of the year 18-19 does not exceed 400 crores, then the basic tax will be levied at 25%. Yes or no? Please respond. Okay. Now, in case of foreign company, the rate of basic tax is higher. So what government has done, wherever the basic tax rate is lower, they have applied the higher surcharge rate, and wherever the basic tax rate is higher, they have taken the lower surcharge rate. So in case of foreign companies, surcharge rate is lower as compared to the domestic companies. Is that very clear? So what is the rate of surcharge to be applied in case of companies? Surcharge will be applicable only when the income is beyond 1 crore. So if the income is up to 1 crore, no surcharge. And the next slab is, if the income is beyond 1 crore, up to 10 crores. Up to 10 crores, those domestic companies are required to pay surcharge at 7%. And if their total income is beyond 10 crores, then the surcharge would be levied at what rate? 12%. On the other hand, foreign companies would also be required to pay the surcharge. Foreign companies also would not be required to pay the surcharge if their income is up to 1 crore. If the income exceeds 1 crore, surcharge would be applicable at what rate? 2%. 2%. Up to what level of income surcharge will be 2%? Up to the level of income of 10 crores. Up to the level of income of 10 crores. And if the income is beyond 10 crores, then the surcharge would be levied at what rate? 5%. 5%. Is that very clear? So in case of first category, we can say that there are 4 rates of surcharge. First slab is up to 50 lakhs of income, no surcharge. From 50 lakh to 1 crore, surcharge is at 10%. From 1 crore to 2 crore, surcharge is at 15%. 2 crores to 5 crores, surcharge is at 25%. And beyond 5 crores, surcharge is at 37%. In case of those who are covered by second category, there is a flat rate of surcharge at 12% if the income is beyond 1 crore. Domestic company, foreign company, you have two rate of surcharge. In case of domestic company, 7% and 12%. In case of foreign company, 2% and 5%. Is that very, very clear? Now, the ICI module is having some examples on the surcharge. Examples on the tax rate to be applied, or surcharge rate to be applied. In what situation, what rate of surcharge will be applied? But to understand those examples, first of all, we need to understand that there are certain incomes on which surcharge can be maximum 15%. There are certain incomes. See, first of all, please understand, surcharge is not levied on income. Surcharge is levied on basic tax. But there are certain incomes in case of which the maximum rate of surcharge can be 15%. Maximum rate of surcharge can be how much? 15%, 1/5. Rest all incomes, the rate of surcharge to be applied will depend upon the level of income. But in case of specifically three incomes, the maximum rate of surcharge can be 15%. In other words, the surcharge rate of 25% and 37% would not apply. Do one thing, we'll understand those examples from ICI module later on. Right now, let's move on to that. We have a specific question on something called as marginal relief. We'll complete this question along with a practical question, and then we'll move on to that special rate of surcharge. Which are those incomes on which the surcharge will be levied at maximum 15%? Those things we'll understand later on. Right now, we'll move on to what? We'll move on to marginal relief concept. We will not read what is written here. We'll directly solve one question, that is question number 4. On a marginal relief, there is a question number 4. How much? 13,66,040. It is after marginal relief. Let's calculate and check. Okay. Shall I proceed? Okay. Question number 4 we are solving. In question number 4, there is a concept of marginal relief. What is that? We'll understand. Calculate the total income of Mr. Modi if his income is, calculate the tax liability of Mr. Modi if his total income is how much? 50 lakhs 1,000. Compute his tax liability for the assessment year 2021. It should be which assessment year? 21-22. Your assessment year for the purpose of examination is 21-22. So this one is misprinted as 2021. Assume that Mr. Modi has not opted for the provisions of section 115 BAC. So he is an individual. Since nothing is given, what would be our assumption? He is covered of which category? Category 1. Category 1. So we have to apply the rate of tax given in the first category. I have one small format in front of me. Instead of copying, you just help me out with calculation of numbers right now. This is the format to make you understand the concept. This is the format. This format you should not use in the examination. Right now, this format is intentionally made to make you understand the concept of marginal relief. Don't try to copy anything. Just give me the answers by doing the calculation. Instead of Mr. Modi, I have taken the name as Mr. Manoj. Can you tell me if the total income of Manoj is 50 lakh 1000, what will be the tax liability? Basic tax liability 13 lakh 12,800. Madam, how will we calculate? 50 lakh 1000 minus 10 lakhs will get you 40 lakhs 1000. On that 40 lakhs 1000, you will apply tax rate at 30%. Whatever amount is derived, on that you calculate, on that you add the amount of 1,12,500. So what is the amount of tax? See, each one of you have to calculate, you are not sitting in the garden. How much? 13 lakh 12,500. So 13 lakh 12,800. You have not applied the surcharge, na? Not the cess also. Basic tax. Okay. So basic tax is 13 lakhs 12,800. Now the question is whether the surcharge is applicable in this case or not. Answer is yes. Answer is yes. What rate of surcharge? 10%, because income is beyond 50 lakh, but it is less than equal to 10 lakhs. So 10% of 13 lakh 12,800 would be how much? 1,31,280. So I am adding surcharge 1,31,280. Now give me what is the amount of basic tax plus surcharge? 080. 14 lakh 44,080. Any one of you are having doubt on this number? Okay. Now, at the same time, if I have earned a total income of 50 lakhs, what will be my basic tax liability? Up to 10 lakh, it is 1,12,500. On an income of 40 lakhs, it is 12 lakh rupees. 12 lakh plus 1,12,500 is 13 lakh 12,500. Yes or no? Madam, have you understood? 13 lakh 12,500. Will I have to pay any surcharge? No surcharge. So my tax plus surcharge amount would remain the same at 13 lakh 12,500. Now my question to you is, as compared to me, how much income Manoj has earned extra? Only 1,000 rupees. This 1,000, we can term it as additional income. If I want to make a formula for calculating this additional income, what can be that formula? Total income minus 50 lakhs. So how did we calculate this 1,000? 50 lakh 1,000 minus 50 lakhs. So 50 lakh 1,000 is nothing but total income, and 50 lakhs is nothing but the level of income at which the surcharge is levied. So 50 lakh 1,000 minus 50 lakh would give me the amount of additional income. In this case, it is only 1,000 rupees. Is that very, very clear? Okay. Now, as compared to me, how much amount of tax Manoj is required to pay extra? So that you have to find out how. From this 14 lakh 44,080, you deduct the amount of 13 lakh 12,500. 1,31,500. This 1,31,580, we can term it as additional tax liability. What do you mean by additional income? Additional income means income which is higher than the slab of surcharge. In this example, 50 lakhs. In this example, the slab of surcharge, slab up to which the surcharge is not applicable, is 50 lakhs. So, my formula for calculation of additional income is what? Additional income is nothing but total income minus 50 lakhs. Is that very clear? So, my formula for additional income is total income minus 50 lakhs. And how do I calculate this 1,31,580? 14,44,080 minus 13,12,800. What is 14,44,080? That is tax on your total income. And what is 13,12,500? That is nothing but tax on 50 lakhs. So, the formula for additional tax liability is nothing but tax on total income minus tax on 50 lakhs. Now, my question to you is, Manoj has earned only 1,000 rupees extra as compared to me. But he is paying extra tax to what tune? 1,31,580. Now listen to me very carefully. Why his tax liability has increased drastically by such a huge amount of 131,500? Because of surcharge. If you think more, then you can say that it is because surcharge is levied not on the tax of the extra income. Surcharge is levied on the total tax of total income. Here extra income is how much? 1,000. On that 1,000, if you calculate the tax, on that 1,000, how much would have been the tax? Only 300 rupees. If you levy surcharge only on that 300 rupees, then this situation is not going to arise. This situation is arising definitely because of surcharge, but because the rate of surcharge is applied not on the amount of extra tax. Not on the amount of extra tax because of extra income, but on the amount of entire tax of the entire income. Have you understood this? Have you now understood the reason why I have bifurcated the amount of income in two parts, up to 50 lakhs, beyond 50 lakhs? To make you understand that surcharge will not be applied on the amount of income, amount of tax on the income beyond 50 lakhs. Surcharge will be applied on the amount of total tax on the total income. Is that very clear? Now you think practically, if in case of Manoj, if he knows that his income has slightly exceeded 50 lakhs, that his income has just exceeded by 1,000 rupees, then he knows that he has to pay the surcharge. What he will try to do? He will try to hide his income to the tune of 1,000 rupees, and he will say that I want only 50 lakh rupees. In that case, he will be out of the net of surcharge. Surcharge will not be levied at all. Yes or no? Should government promote such kind of thing? No. So government says, when your income is slightly higher than 50 lakhs, and because of that, you are required to pay very heavy amount of tax due to the applicability of surcharge, we are going to provide you a relief. So relief will be applicable when your income is slightly higher than the limit of 50 lakhs. And because your income is slightly higher than the limit of 50 lakhs, you have to pay surcharge on the entire amount of tax. And there arises a situation wherein your extra tax liability is much beyond your extra income. Are you understanding this? Yes or no? Say each one of you have to reply. Have you understood this? So every time what you have to do, when your income is slightly higher than 50 lakhs, you have to, step 1, you have to ascertain what is the additional income. Step 2, you have to ascertain what is the additional tax liability. Have you understood these two steps? So first step is to ascertain the additional income. In our example, additional income is nothing but 50 lakh 1,000 minus 50 lakhs. That is 1,000 rupees. This is our step number 1. Then you calculate the additional tax liability. Additional tax liability is tax on total income. In our case, what is tax on total income? 14 lakhs 44,080 minus tax on 50 lakhs. What is tax on 50 lakhs? 13 lakhs 12,500. So you get the amount of additional tax liability as 1,31,500. Now the point is, Since your income has slightly exceeded 50 lakh limit, if you apply the surcharge and your tax liability has drastically increased because of the applicability of surcharge, and if we don't provide you relief, then you are going to do the tax evasion. So instead of promoting tax evasion, government says you declare your real income and we will offer you a relief. And this is called as marginal relief. Relief is logically similar to rebate. In rebate, you get a discount from your tax liability. So you calculate some amount of rebate and you deduct the amount of rebate from your tax liability. Here also, we will calculate some amount of relief. A person whose tax liability has increased unduly, he will be eligible to claim a relief. And relief amount will be calculated, and relief amount will also be deducted from the amount of tax liability only. But this will be deducted from basic tax plus the surcharge. Rebate under section 87A was deducted from the basic tax, whereas marginal relief will be deducted from the amount of basic tax plus surcharge. Have you understood this much? Now, how many things you have calculated? Two things. Number one is additional income and number two is additional tax liability. Now, there are three possibilities. You compare these two parameters, additional income and additional tax liability. There are three possibilities. Your additional income is less than the additional tax liability. This is one possibility. For example, in our case, the additional income is 1000 rupees and the additional tax liability is 1,31,580. So my additional income is less than the additional tax liability. Have you understood this? Yes or no? Second possibility is, see, in economics you might have learned something called as law of diminishing marginal utility. In that diagram there is something called as point of satiety. Point of satiety is a point at which you will have a highest level of satisfaction. Thereafter your curve will bend downwards. Similarly, here there will be a point wherein your additional income and additional tax liability, both amounts would be equal. There will be some level of income wherein your additional tax liability and additional income amounts are same. Please respond. Are you understanding this? So second possibility is your additional income and additional tax liability, both amounts are same. What is the third possibility? Your additional income is more and your additional tax liability is less. So there are three situations. Now tell me, when you are at a losing end, or when you are losing something, or when you are at a detrimental position, when your tax liability, when your additional tax liability is more as compared to additional income, or additional tax liability is less as compared to additional income. Question is, as an SSE, when you will face the difficulty, when you will face the hardship, when your extra income is more or when your extra tax liability is more? When your extra tax liability is more as compared to the extra income which you have earned. So you are suffering only in one situation. You are at a losing end only in one situation. You are facing hardship only in one situation. And which one is that? When your additional income is less than the additional tax liability. So in this case, in our example, your additional income is only 1000 and your additional tax liability is 1,31,580. Just because of earning only 1000 extra, you are required to pay an extra tax of 1,31,580. Don't you feel that you will be facing undue hardship? So only in this situation, government is going to give you a relief. So relief will be available in which situation? Only when your additional income is less as compared to your additional tax liability. Now, government is asking you a very simple question. Do you want to pay additional tax or do you want to forego your extra income, that is additional income? What is your additional tax? 131,580. What is your additional income? 1,000 rupees. So government is asking you a question. Are you ready to pay additional tax of 131,580, or you are ready to forego the additional income of 1,000 rupees? So what you will say? I don't want to pay the additional tax liability. You take away the amount of additional income. I will presume that I have never earned that extra income of 1,000 rupees. So instead of charging 1,31,580 rupees, government says we will take away your additional income from you. So how much government will take away from you? Only 1,000 rupees additional income. In other words, actually you were liable to pay the amount of 1,31,580, but government took only 1,000 rupees from you. In other words, government offered you a discount. Government offered you a relief to what extent? Instead of 131,580, government is only taking 1,000 rupees. So government has offered you a discount of 1,30,580. Is that very, very clear? Yes, this side. So what is the formula for marginal relief? Marginal relief equals to additional tax liability minus the additional income. So step number 1, see, you understand the process, because every time the marginal relief amount will change. So you should understand the steps. Your step number 1 is to calculate the additional income. Step number 2 is to calculate the additional tax liability. Step number 3, you compare the amount of additional income with the amount of additional tax liability. You decide out of 3 situations A, B and C, you are falling into which situation. If you fall into situation A, when you will fall into situation A? When your additional income is less and your additional tax liability is more. In that case, you will fall into situation A and you will be eligible to claim marginal relief. What will be the quantum of marginal relief? Marginal relief is nothing but additional tax liability minus the amount of additional income. So in our example, what is the amount of additional tax liability? 131,580. Now instead of paying the tax of 131,580, you are saying to the government, take away my extra income. I will take an assumption that I had never earned this income in the past. So I am ready to forego my income in your favor. So government is ready to take away 1,000 rupees. So how much discount government has offered to you, how much relief government has offered to you is 131,580 minus 1,000. That is 1,30,580. Is that very, very clear? So my formula for the margin relief is margin relief equals to additional tax liability minus the additional income. In this case, it is 131,580 minus 1,000. That is 1,30,500. Is that very, very clear? So first of all, listen to me carefully. First of all, whenever you feel that your income is slightly higher than 50 lakhs, first of all, you have to calculate what? Basic tax. Then you have to apply the surcharge. Then you ascertain the amount of basic tax plus surcharge. Thereafter, you calculate the amount of additional income. See, this column you are not required to make in the examination. It is only for your understanding. So you will be making only one column in the examination, single column. So what you will do? You will calculate the basic tax, you will calculate the surcharge, you will add the basic tax and surcharge, so you get the amount of basic tax plus surcharge. Then you go and calculate additional income. Apply the formula, additional income equals to total income 50 lakh 1,000 minus 50 lakhs. Then you calculate the additional tax liability equals to what? Tax on total income minus tax on 50 lakhs. You calculate tax on 50 lakh 1,000. Then you calculate tax on 50 lakh. Tax on 50 lakh you should calculate orally. Then you deduct the amount of total tax. From the amount of total tax, you deduct the amount of tax on 50 lakhs. And you arrive at the amount of additional tax liability. Once you have arrived at the amount of additional tax liability, you compare two parameters, whether your additional tax liability is less than the additional income or it is more than the additional income. If your additional tax liability is more, additional income is less, then you are eligible to get the marginal relief, and marginal relief is nothing but additional tax liability minus the additional income. Is that very clear? So, you have to apply three formulas to ascertain the amount of marginal relief. Once you arrive at the amount of marginal relief, that should be deducted from the amount of basic tax plus surcharge. So, in this case, we will deduct 1,30,580. If I deduct the amount of 1,30,580, the balance tax will be how much? 13 lakhs? 13 lakh 13,000. Now you look at the second column. Here there is nothing in the form of relief. So here it is 13 lakhs 12,500. Now if you find out the difference between them, it is 1,000 rupees. And if I ask you a question, what is this 1,000? It is nothing but the extra amount of income which you have surrendered to the government instead of paying the extra tax. Now on this amount you apply this as at 4%. So 4% of how much? 52,540. 52,540. 13 lakh. And here 13 lakh 12,500 into 4% is how? 52,500. 52,500. 13 lakh 65,000. Now you tell me what is the difference between them? 1,040. Now, are you understanding this? Now, if I ask you, this 1,040 is consisting of what? It is consisting of two things. Number one, it is consisting of additional income. How much? 1,000 rupees. And number two, it consists of cess on additional income. Cess on additional income at 4%. That is 4% of 1,000 rupees. That is 40 rupees. In other words, have you understood these numbers? Okay. In other words, my question to you is, do you believe that government is offering you relief from the amount of education cess? No. Whether the government is offering you relief from the education cess? No. Government is offering you relief only because of surcharge. Government is not offering you relief because of education cess. So if you look here, your extra income, additional income was 1,000, and your extra tax liability after relief is 1,040. Means the 1,000 amount additional income you offer to the government, on that 1,000 also you paid 40 rupees as cess. So still you are losing only. How much? Only 40. Have you understood? So marginal relief is offered only on surcharge. It is not offered on health and education cess. Have you understood this very clearly? So with this, our discussion of marginal relief is over. If any one of you are having any smallest of the doubt, please do ask right now, because I want to change the situation and ask you the question. Is that 100% clear? Okay. Now, what if I change the numbers and I say that the total income is 1 crore 1 lakh. Total income is 1 crore 1 lakh. Don't calculate anything. I just want to understand whether you understood the procedure correctly or not. Because if you understood the procedure, I may change the numbers 10 times. Every time you get the correct answer only. My question is, if your total income is how much? 1 crore 1 lakh. So can I say if your income is 1 crore 1 lakh, definitely there is a surcharge? At what rate? 15%. 15%. So while I calculate the additional income, I should compare what? Total income I should compare with 50 lakhs, or should I compare the total income is 1 crore? I will compare the total income with 1 crore. This is my step number 1, calculation of additional income. Additional income is total income minus something. That minus something is not always 50 lakhs. It is the lower side of the slab of surcharge. Are you understanding? Okay. Then you calculate additional tax liability. What is the formula of additional tax liability? Tax on total income minus tax on 50 lakhs, I told you. But in this example, if your income is 1 crore 1 lakh, then your additional tax liability formula will change. It will be what? Tax on 1 crore 1 lakhs minus what? Minus tax on 1 crore. Have you understood this very clearly? Yes or no? Okay. Now, very important point is that tax on 1 crore will also include the surcharge. But that tax on 1 crore will include the surcharge at what rate? 10%, and your tax on total income will include the surcharge at 15%. Have you understood this? So every time the amount of additional income, additional tax liability is going to change. For every person it will change, and whenever you reach to a higher surcharge rate, it is going to change. Is that 100% clear? See, I'm already having few MCQs for this basic concept chapter. This chapter is nearly over now. Once the chapter is over, I'll be sending you are having a WhatsApp group. So in that group, you'll be getting two things. Number one, you will receive chapter-wise MCQs. In WhatsApp group, he is not going to send you. Sir told me that he'll be uploading those MCQs in that some mobile app or something. Or Telegram, or I do not know. So he will update the MCQs there. You can take an online test. The moment you submit the online test, at the same moment you will come to know that which answer is incorrect and which answer is correct. So chapter wise you will get a practice of MCQs. In this basic concept chapter, I am having a lot of MCQs wherein you are required to calculate the marginal relief. So every time will be required to calculate. You will get a lot of practice when it comes to MCQs. Once you solve the MCQs, see, objective of the MCQs is to solve within a span of maximum 1.5 minutes. The problem which students are facing in the examination is everyone knows everything. When it comes to MCQs, they know how to calculate, but they are consuming time. They are taking 4 minutes, 5 minutes in each of the MCQs. And the moment you start with the MCQs and a lot of time is consumed in MCQs, first hour is gone. Then the next hour, you will lose your confidence, and the third hour would be worst. So MCQs, when you sit at home to solve, you should keep a timer in front of you. MCQs, you should keep a timer in front of you. Every MCQ should be solved in a maximum number of marks multiplied by 1.8. 1.8 means for a 100 marks paper, 180 minutes are given, 3 hours. So for every mark you are having 1.8 minutes. So for one MCQ you should not take more than 1.8 minutes. Say for example, one MCQ would be involving a lot of calculation. So you can devote maximum 2 minutes, maximum. And if it is a theoretical MCQ, you can give the answer within a span of 30 seconds. So somewhere you have to save the time and somewhere you have to utilize more time. But in any case, you cannot spend more than 2.5 minutes on any of the MCQs. So in MCQ, the challenge is what? You read the MCQs at the same time, calculation should go in your mind, or you should start doing the calculations on the calci. If you wait, if you read the entire paragraph, then you think what calculations are required to be done, it will definitely consume 4-5 minutes. So in MCQs, your reading of the question and the calculation, both should go simultaneously. Only then you will be in a position to solve the MCQs in a span of 1.5 minutes or 2 minutes. And at home when you sit, please keep a timer. It is not an unlimited time examination. Keep a timer. Try to achieve the speed. Once you do the MCQs, all the calculations in a practical question will be very simpler for you. See, writing speed automatically increases if you know the answer. It is natural. Say for example, tiger is running behind you, and you have in past you have never gone in some marathon race. Do you believe that if tiger is running behind you, your speed will be slower? No, naturally it will increase. So the examination environment is such that if you know the answer, your writing speed will automatically increase. So for knowing the answer, your processing power should be higher. So keep the timer and solve the MCQs. So marginal relief we have completed. What we can do is, from the CA Institute module, I will discuss the surcharge examples which are very important, and CA Institute has inserted that only in May 21 module. Those I think were not appearing in May 20 module. Yes. Shall we start? Manoj? Shall we start? Very good. Every time I need to ask permission from you. So I'll be solving some, we'll be looking at some examples from the ICI module. I have not taken those examples in these notes. So what you can do is you can write the page numbers of ICI module and the example numbers. These examples are inserted by ICI in the module from May 21 onwards. In other words, these examples were not part of the module in the earlier attempt. Shall I proceed? Yes, please focus here. You know that surcharge is levied on the amount of basic tax. And you know that there are different rates of surcharge. Rate of surcharge also depends upon the level of income. But there are three certain specific incomes. There are certain specific incomes. How many incomes? Three incomes, wherein the rate of surcharge is capped. Rate of surcharge is capped means this will be the highest rate of surcharge. Rate of surcharge is capped at 15%. In other words, surcharge rate can be less than 15%, but it cannot be more than 15%. So the maximum rate of surcharge which would be applicable in case of those incomes would be 15%. So for understanding that, we can divide the incomes into two categories. Number one, first category includes three incomes. Number one, short-term capital gain. See, you might not be knowing what is short-term capital gain. It is nothing but gain on sale of asset. This we'll discuss in detail in the chapter of income from capital gain. Right now, you just remember the list of income, that's all. Short-term capital gain, which is covered by section 111A. Short-term capital gain means capital profit on sale of asset. So, yes, please focus here. Short-term capital gain, which is covered by section 111A. On this, the basic tax rate is 15%. What is the basic tax rate? 15%. In other words, this income should not be added to the normal income. The slab rate of tax is not applicable in this case. The basic tax rate is 15%. This is basic tax rate. Long-term capital gain, which is covered by section 112A. What is included there, that we will not discuss right now. We will discuss in the chapter of capital gain. But you have to just remember the list of three incomes. Long-term capital gain, which is covered by which section? Section 112A. On this, the basic tax is at the rate of 10%. These rates we are going to discuss once again in the chapter of capital gain. Right now, my objective is to make you understand surcharge. This dividend income, if you are an individual, HUF, association of person, body of individual, artificial juridical person, etc., then this dividend income is taxable at slab rates. Do you understand slab rates? Up to 2.5 lakh, there is no tax. Beyond 2.5 lakh, up to 5 lakh, at basic exemption category 1, 2, 3, etc. So I have shared with you the rate of basic tax in case of these three different incomes. Now the next target is to understand that whatever amount of tax you have calculated on these three incomes, if at all this surcharge is applicable in your case, if at all the surcharge is applicable, you decide the rate of surcharge looking at that table. But if you fall into a surcharge rate which is higher than 15%, for example, your income is, say for example, 4 crores, then what is the rate of surcharge applicable if you are individual? 25%. So can I say this 25% surcharge is higher than the rate of 15%? In that case, the surcharge rate will be capped at 15% in case of tax calculated on these 3 incomes. So I am telling you that maximum rate of surcharge can be 15% in case of these 3 incomes. Can the surcharge rate be less than 15%? Yes, it can be less than 15%, but it can never be more than 15% in case of tax calculated on the amount of these 3 incomes. Have you understood this? Okay, other incomes. On other incomes, you calculate tax as per whatever rate is applicable to you. And on that amount of tax, you apply the surcharge as per the slab of income. If your slab of income is between 2 crores and 5 crores, you apply the surcharge at what rate? 25%. If your slab of income is beyond 5 crores, you apply the surcharge at 37%. Have you understood this much? So my point is, when this provision would be applicable, when this part will be applicable? When this part is required to be applied? This part is required to be applied only when your actual surcharge rate is more than 15. If your surcharge rate is anyway less than 15, then this is not going to apply. Because in this case also, say for example, you are falling into the slab of income of 50 lakh to 1 crore. What is the rate of surcharge in your case, in that case? 10%. So on the tax liability of the special incomes also, surcharge rate will remain at 10% only. Because in this case, the surcharge rate can be less than 15%, but it cannot be more than 15%. In other words, this surcharge rate can be capped at 15%. So we are talking about those situations wherein the actual rate of surcharge applicable in your case is more than 15%. Is that 100% clear? Yes or no? Shall I move on to the examples? So you can write the page number, it is page number 1.43 in ICR module. Example number 9. See, there are 5 situations. Every situation we will understand, and against every situation they have taken an example. In the example, we have to find out what is the rate of surcharge applicable to which tax. Where the total income including including those 3 special income. Which are those 3 special income? Short-term capital gain covered by section 111A, long-term capital gain covered by section 112A, and dividend income. Where your total income, including all these 3 special income, is more than 50 lakhs, but it is less than equal to 1 crore. Tell me, what is the surcharge rate applicable to you? In that case, surcharge rate on the tax of normal income will be 10%, and the surcharge rate on the tax of the special income will also be 10%. Yes or no? Have you understood? See, you should understand 100%. If you don't understand, please do ask. We move on to example number 9. They say that your dividend income is 10 lakhs. Your short-term capital gain covered by section 111A is 20 lakh rupees. Your long-term capital gain covered by section 112A is 25 lakh rupees, and your other income is 40 lakhs. You take the total of all the income, that turns out to how much? 10 plus 20 is 30 plus 25 is 55 plus 40 is 95. So can I say your income is beyond 50 lakh but less than equal to 1 crore? So the rate of surcharge applicable in your case is 10%. So this 10% would be applied on the amount of tax of special income or the amount of tax of other income or the amount of tax of all income. Amount of tax of all income. Is that very clear? In case of special income, the maximum rate of surcharge is 15%. But if the actual rate of surcharge is less than 15, you apply the actual rate of surcharge. Is that 100% clear? Yes, anyone of you having doubt in this example number 9? No. Let's move on to second situation. Second situation says where your total income, including these three special income, including section 111A, 112A and including dividend income, is how much? More than 1 crore, but it is less than equal to 2 crores. So in that case, what is the rate of surcharge applicable to you? 15%. On this tax of special income, what is the maximum slab of surcharge? 15%. And your normal tax, the rate of surcharge is also 15%. So what should we do? We should apply the surcharge at the rate of 15% on the entire amount of tax of entire income. Is that very clear? So yes or no? So example number 10 says your dividend income is 10 lakh. Your dividend income is 10 lakh. Your short-term capital gain covered under section 111A is 60 lakhs. Long-term capital gain covered in section 112A is 65 lakhs and your other income is 50 lakhs. If you take up the total, that would turn out to 1.85 crores. Means your surcharge rate is how much? 15%. So you apply the surcharge rate of 15% on the entire amount of tax of entire amount of income, including the special income. Is that 100% clear? So with this, example number 9 and example number 10 are over. Now if you refer to this example, this situation number 1 and 2 says your total income including the special income. So they are looking at the amount of total income including the special income. Now if we move on to situation 3. Situation 3, they are saying that your total income excluding the amount of special income. Total income excluding section 111A short-term capital gain, total income excluding section 112A long-term capital gain, total income excluding the amount of dividend income. If the total income excluding these three special incomes is more than 2 crores but it is less than equal to 5 crores. So first of all, your total income should be bifurcated in two categories: special income, other income. And this, for looking at this slab, you have to look at which amount? Amount of total income including the special income or only other income? Only other income. So you remove the special incomes, remaining income you look at that, then you decide which rate of surcharge is applicable. If your total income excluding these three special income is more than 2 crores but it is less than equal to 5 crores, you fall into what rate of surcharge? 25%. Now listen to me very carefully. If excluding the special income, if you fall into 25% surcharge rate, definitely if you include the special income also, then also you will fall into at least 25% surcharge rate. Yes or no? But you know that in case of special income, the maximum rate of surcharge is how much? 15%. So what you will do? You will bifurcate your income into two parts: special income, other income. On special income, you will calculate tax at special rate. On that amount of tax, you will calculate surcharge at 15%. Because the 15% the highest amount of surcharge we can apply to tax of special income. On other income, you will calculate the tax amount. On that tax amount, you will calculate surcharge at what rate? 25%. See, your income is how much? More than 2 crore, less than equal to 5 crores. So you fall into which slab of surcharge? 25%. But the special income surcharge is restricted to 15%. So on that special income, you calculate the tax. On that amount of tax, you take the surcharge at 15%. Then you calculate the tax on other income. On that tax of other income, you calculate the surcharge at 25%. Is that 100% clear? Yes or no? So procedure is what? You bifurcate the income into two parts. That you have to apply in third situation. So here also they have taken the example number 11. They are saying that dividend income is 60 lakhs, short-term capital gain covered by section 111A is 54 lakhs, long-term capital gain covered by section 112A is 55 lakhs, other income is 3 crores. If the other income is 3 crores, you are falling to which slab? 2 crore to 5 crores. If you fall into 2 crore to 5 crore, what is the rate of surcharge? 25%. But you know that on the tax of special income, you can levy the surcharge at maximum rate of 15%. So what you will do? On this other income of 3 crores, you will calculate the tax. On that tax, you will apply the surcharge at 25%. On this 3 special income, you will calculate the tax by applying the special rate, etc. Whatever tax amount is arrived, on that you will calculate the surcharge at 15%. Is that very clear? So they say that surcharge will be levied at 15% on the dividend income, short-term gain, long-term gain. And surcharge will be levied at 25% on the tax of other income of 3 crores. Yes, have you understood this? So all these things would come into play only when you are having those 3 special incomes. If you don't have those 3 special income, then you calculate the surcharge in the normal manner. Is that very clear? So in the textbook, just I have written this in the form of a note, but I have not taken the multiple examples. So in the textbook on page number 14, just below that you can write, refer example number 9, 10, 11, 12 and 13. Refer example number 9 to example number 13 from ICI module. Right there in your textbook on page number 14. Refer example number 9 to example number 13 from ICI module. Madam, she is learning for the first time. No, she is learning for the first time. If you ask doubts to her, whether you get the correct answer or not, I don't doubt her capability, but I am not teaching for the first time. So if you have doubts, please do ask directly. I'll help you out. My job is to ensure that you don't have the doubts. See, my job is to ensure that you become independent while solving the questions. If I solve the question and give you the answers, there is no point in taking the lectures. You should be in an independent position to solve the questions. That can happen only if you understand the theory well. So if you have doubts, please do ask. I can take some other example other than this also. Is that very clear? Shall I proceed to the next example? Example number 12, situation number 4. First of all, we'll move on to situation. What it says? Where the total income, including or excluding? Excluding those 3 special income is how much? More than 5 crores. If your total income excluding those 3 special income is more than 5 crore, can I say even if we include that special income, you will fall beyond 5 crores only? So if your income is beyond 5 crores, what is the rate of surcharge? 37%. But you know that on a special income, the rate of maximum surcharge is capped at 15%. So on the other income, you will calculate the tax. We will apply the surcharge rate at 37%. On the special income, we will calculate the tax and you will apply the surcharge at 15%. Is that very clear? Let us move on to the example. What it says? Dividend income is 60 lakhs. Short-term capital gain covered under section 111A 50 lakhs. Long-term capital gain covered under section 112A 60 lakhs, other income is 6 crores. You decide the rate of surcharge based on the other income only. If your other income is 6 crores, you are falling beyond 5 crores. So the rate of surcharge applicable to you is 37%. But on a special income, you will apply the surcharge at maximum 15%. So you will apply at 15%. Is that very, very clear? So it says surcharge will be levied at 15% on the income tax of dividend, short-term gain, long-term gain. And surcharge will be applied at 37% on the income tax of other income of 6 crores. Have you understood? 100%. Situation 5, I will read and I will ask you what they are explaining in situation 5 or what situation they are covering in point 5. If you have understood point number 1, 2, 3, 4, then only you can think about situation 5. Do you have any doubts in point 1, 2, 3, 4? Can you tell me what is common in point number 1 and 2? Common in 1. In point number 1 and 2, we are including the special income and we are looking at the slab rates with respect to surcharge. Point number 3 and 4, we are deciding the rate of surcharge. We are looking at the rate of surcharge excluding the special income. Is that very clear? Point number 5 is the most important out of this 5. What it says, where the total income including the special incomes, where the total income including the special income is more than 2 crores. Total income including the special income is more than 2 crores. And the case is not covered in situation 3 and situation 4. So point number 5, if you want to fall into point number 5, the two conditions are, your total income including the special income should be more than 2 crores. This is the first condition. What is the second condition? You should not be covered by point 3 and point 4. In other words, if you are covered by point 3 and point 4, go in point 3 and point 4. Can you imagine of a situation wherein the total income including the special income is more than 2 crores, but you do not fall into point 3 and you also do not fall into point 4? Have you understood something? Have you understood the previous 4 situations very clearly? Okay. Now forget about that. You tell me, if your total income is more than 2 crores, what will be the rate of surcharge applicable to you? Rate of surcharge applicable to you will be, you keep that page number 15 in front of you. First of all, keep that page number 14 in front of you. Now, if your total income including the special income is more than 2 crore, what will be the rate of surcharge applicable? 25%. Now, can you tell me in the earlier situations, where the rate of surcharge of 25% was applicable? In third situation, surcharge of 25% was applicable. Yes or no? In fourth situation, surcharge of 37% was applicable. If I try to compare situation 3 and 4 with the situation 5, situation 5 says that you can come into situation 5 only if you are not covered in point number 3 and 4. The other point is, in point number 5, we are including other income, whereas in point number 3 and 4, we are excluding other income. So only one situation, if you think very thoroughly, you can imagine of only one situation which can be covered in point 5, and that situation is your other income is less than 2 crores. Your other income is how much? Less than 2 crores. But if you add the special income to other income, then the total income is beyond 2 crores. If your income is up to 2 crores, what is the rate of surcharge? If your income is up to 2 crores, what is the rate of surcharge? 15%. If your income is beyond 2 crores, up to 5 crores, the rate of surcharge is 25%. So there is a jump of surcharge from 15 to 25. My point is, If you just look at the other income, then it is less than 2 crores. So if you just look at the other income and decide the rate of surcharge, that would be how much? 15%. But if you add your special income to the other income, then the total reaches beyond 2 crores. In that case, the surcharge rate would be how much? 25%. Do you understand this? In other words, because of adding your special incomes to the normal income, your rate of surcharge is increasing from 15% to 25%. Your rate of surcharge is increasing from 15% to 25% because of adding your special income to other income. And you know that on a special income, the maximum rate of surcharge is 15%. You keep aside the special income and your other income will fall below 2 crores. Your total income is more than 2 crores because you have already added this special income to the other income. If you remove this special income, your other income will fall below 2 crores. So in that case, on other income also, the surcharge rate would be 15%. Yes or no? Have you understood the situation? Say yes or no. If you have not understood, say no. See, it is not a crime to say no. And it is not necessary that you may understand everything at a first instance only. I repeat, your other income is how much? Less than 2 crores. So what is the rate of surcharge to be applied on other income? 15%. But if you refer to the table of surcharge, it doesn't say that you just look at the other income. It says that you look at the total income. Now, if you add this special income to the other income, then your slab increases. Your income goes beyond 2 crores and the rate of surcharge increases from 15% to 25%. In other words, the rate of surcharge has increased because of adding your special income to other income. And the special income which you are adding to other income, that income itself is, on that income itself, there is a cap of 15% of surcharge. So on that special income, you apply 15%. So you keep aside the special income, your income is anyway below 2 crores. So in case of other income also, the surcharge rate would be applicable at the rate of 15%. Have you understood? So situation 5 is covering only one situation. Situation 5 is talking about a level of other income which is less than 2 crores, but if you add special income, your income goes beyond 2 crores, so your surcharge rate is getting increased from 15% to 25%. If you only look at other income, rate is 15%. If you look at the total, rate is 25%. In that case, we can say that which income is responsible for the increase in the rate of surcharge? Special income is responsible for the rate of increase in surcharge. In that case, other income will be levied surcharge at 15%. Special income is anyway maximum rate of surcharge at 15%. Conclusion is entire income surcharge will be levied at 15%. Is that 100% clear? See, out of 5, the most important is situation number 5. Special income 2.4 crores. 1 crore. 2.1 crore. No, let him ask. Just give me the numbers. Other income is? Okay. Other income is 1.5 crore. Okay. Other income, he says that other income is 1.5 crore. So if you just look at other income, what is the rate of surcharge? 15%. 15% is correct. And what is the special income? 2.1 crore, and special other income is 1.4 crore. You add up those, that would turn out to be 3.6 crore. So you fall into which rate of surcharge? 25%. So can I say Because of adding your special income to other income, your rate of surcharge has increased. If you forget about the special income, if you just look at the other income, then what is the rate of surcharge? What was the other income? 1.4 crores? 1.5 crores? In that case, you tell me what is the rate of surcharge? 15%. If you add special income to your income, your surcharge rate increases from 15 to 25%. So can I say the rate of increase of surcharge, which income is responsible for that? Special income is responsible for increase in the rate of surcharge. So you are talking about the same situation, you have just changed the numbers. It will fall into case 5 only. It will fall into case 5 only. One minute, please. First of all, have you understood what he is trying to say? Do you want me to share his doubt with you? Listen to me very carefully. Listen to me very carefully. He has given the numbers. He says that other income is 1.4 crores. Now you tell me, you just look at the other income. You just look at the other income. What is the rate of surcharge? 15%, correct? Okay. Now you tell me in situation 1 and 2, you are asserting the rate of surcharge including the special income or excluding the special income? Including the special income, correct? Okay. Now you add the special income to the normal income. Normal income is 1.4 crores and other income is, for example, 2.5 crores. So total is how much? 3.9. Can you tell me, are you falling into the first situation? No. So first situation is not applicable in your case. Are you falling into the second situation? No. So you are not falling into second situation also. Now you tell me, what is your income excluding special income? Is it more than 2 crores? It is less than 2 crores. So can I say you are not covered by situation 3 also? Yes or no? So look at situation 4. What is your other income? 1.4 crores, 5 crores, whatever it is. So can I say it is not exceeding 5 crores? So you are not falling into case 4 also. So when you don't fall into case 1, 2, 3, 4, you will automatically fall into 5 only. You will automatically fall into 5 only. I have just taken an extra effort to make you understand what is that situation wherein you will fall into 0.5. Government has not explained that. Government has kept as a residuary category. But in that residuary category, there is only one situation. What is that situation? Your other income is taxed. On the other income, the surcharge is at the rate of 15%. If you add the special income, the rate of surcharge increases to 25%. This is the only situation covered by 0.5. You have given the different numbers, but your situation is also falling into 0.5 only. Is that very, very clear? Anyone of you having doubt? Second last bench. Is that 100% clear? Do you want to change the numbers? Tell me. Both are 2.5 crores. Okay. Now you tell me, are you falling into situation 1? Situation 1 says your total income including the other income should be between the range of 50 lakh to 1 crore. Your income is how much? 5 crore. So you do not fall into first situation. Are you falling into second situation? No, you don't fall into second situation also. Third situation, fourth situation, you look at which income? Other income. So other income is how much? 2.5 crores. So they say that other income is more than 2 crores, less than 5 crores. So can I say you are falling into third situation? Because your other income is more than 2 crore, less than equal to 5 crore, you are falling into third situation. Yes or no? So your other income, what would be the rate of surcharge applicable? 25%. And what should be the rate of surcharge to be applied on special income? 15%. So the point is, if you recollect, I had drawn this flow chart. This bifurcation is required to be done only when the rate of surcharge on the special income goes beyond 15%. Only when the rate of surcharge on the special income goes beyond 15%, you bifurcate your income, calculate the taxes separately. On the special income, calculate the tax, on that apply surcharge at 15%. On the other income, calculate the tax, apply surcharge at whatever rate is applicable to you. Is that 100% clear? So these are the important examples which are taken up by ICI in the module in this year. Last year, this kind of examples were not appearing in the module. So I strongly believe that CA Institute may ask some situation out of this, not as a descriptive question, but as a part of MCQ. As a part of MCQ, they can definitely ask this. So with this, our discussion with respect to the first chapter, that basic concept, comes to an end. This you might not have discussed. Whoever has completed their portion in the earlier attempt, this point might not have been discussed. The reason is that dividend income is inserted newly. It is an amendment of budget 2021, but it is a retrospective amendment. That is the reason it was not taught to you in the earlier batch. Is that very clear? So our first chapter is entirely over. Don't expect that new chapter should be started on a fresh day, because in that case, totally we are having lectures for 25 days and there are 16 chapters. Yes, shall we proceed? Okay. No, I am just asking your permission for formality. Even if you say no, I need to proceed. So we move on to second chapter, residential status and scope of total income. In this also there are amendments. Section 6 subsection 1A is inserted. Section 6 subsection 6 is amended. Section 6 subsection 1A is inserted and section 6 subsection 6 is amended. So there are amendments here. Budget 2000 amendments are applicable here. 2020. What is the name of chapter? Residential status and scope of total income. If I ask you a very simple question, tax liability is calculated on what? What is the answer? Tax liability is calculated on total income. Tax liability is calculated on total income. I do not know once I write how to remove. Okay. Tax liability is calculated on what? It is calculated on total income. This total income, how much will be your total income? Can I say tax liability amount is dependent on the amount of total income? In other words, higher the total income, higher is the tax liability, lower the total income, less is the tax liability. The way tax liability is dependent on the amount of total income, similarly, total income depends upon scope of total income. Total income depends upon what? It depends upon scope of total income. Here we can say that there are two possibilities. Number one, the scope of income can be wider or the scope of income can be narrow. Narrow means less things will be covered in the scope. And when we say scope of income is wider, means more number of incomes will be covered within the scope of your total income. For example, earnings and total income, these are two different things. You might have earned 25 lakhs. That doesn't mean that your total income will be 25 lakhs. Your total income will be calculated by applying the provisions of Income Tax Act. Your total income can be more than 25 lakhs also, it can be less than 25 lakhs also. Your total income doesn't have any connection with your earnings. You might have earned 25 lakhs, but if you calculate the total income as per the provisions of Income Tax Act, that total income can be less than 25 lakhs or it can be more than 25 lakhs. So the word total income is something different and the word earning is something different. Earning is income in a layman language. Total income means by applying the provisions of income tax. When I say, Acha, tell me, you can earn income from India only or you can also earn income from abroad? You can also earn income from abroad. So we say that when the scope of income is wider, we mean to say that whatever income you earn in India, we call that income as Indian income. That Indian income will be taxable to you, and whatever income you earn from some other country, which we may term it as foreign income, that foreign income will also be taxable to you. So when the scope of your income is wider, whatever income you have earned in India is definitely taxable, but whatever income you have earned outside India, that is also taxable in India. But if we say that the scope of income is narrower, in that case what will happen? In that case, income which is earned in India is taxable, but income which is earned in foreign country, which is a foreign income, that is not taxable. For example, I have earned 5 lakhs from India, I have earned 5 lakhs from foreign country, so my Indian income is 5 lakhs, my foreign income is also 5 lakhs. Manoj's Indian income is also 5 lakhs and his foreign income is also 5 lakhs. In other words, our earnings are 10 lakhs, but it is not necessary that our total income is 10 lakhs. If his scope of income is wider, his total income will be 10 lakhs. And if my scope of income is narrower, my total income will be only 5 lakhs. So the word earnings and the word total income are totally different. Is that very clear? Now the question arises, when your scope of income will be wider and when the scope of income will be narrow. When your scope of income will be wider and when your scope of income will be narrow, that depends upon the residential status of a person. That depends upon what? Residential status of a person. Residential status means it is very simple thing. If a person is residing in India, he is a resident person. If he is residing outside India, he is a non-resident person. You might have heard the word NRI. NRI means non-resident Indian. He is not residing in India, so we call him as non-resident person. So there are two possibilities here. Either you are resident or you are non-resident. If you are resident, we say that in your case, scope of income is wider. In other words, in your case, Indian income as well as foreign income, both are taxable. But if you are a non-resident person in India, then the scope of income is narrow. What will become taxable to you is only the Indian income. Foreign income will not be taxed to you. Is that very clear? Have you understood this flow? Okay. Now my question, yes. So question number 1, tax liability depends upon what? Tax liability depends upon what? Total income. Total income depends upon scope of total income. Scope of total income in turn depends upon residential status of a person. So the name of the chapter is residential status and scope of total income. Chapter is divided in two parts, residential status and part 2 is scope of total income. Before we begin the chapter, very simple question to you is, what is dependent on what? Residential status is dependent on scope or scope is dependent on residential status? Scope is dependent on residential status. In other words, you cannot understand the scope unless and until you have understood the residential status. Therefore, the name of the chapter is residential status and the scope of total income. So, the part 1 of the chapter is residential status. Is that very clear? Residential status means we need to decide whether a person is resident or non-resident. So there are certain common set of rules in case of all persons. There are how many categories of person? 7 different category of person. Individual, HUF, firm, company, association of person or body of individual whether incorporated or not, local authority and artificial juridical person. If you want to ascertain the residential status of all these different persons, government has made different sections. And the provision which is talking about the residential status is section 6 of the Income Tax Act. It is section 6 of the Income Tax Act. We are on which page in your textbook? Page number 17. In that second half of the page says basic rules for determining the residential status of a person. If you want to decide the residential status of a person, you have to refer to how many sections? 3 sections. Section 6 subsection 1, section 6 subsection 1A. This is newly inserted section by budget 2020. And the third one is section 6 subsection 6. If you want to decide the residential status of HUF, then the provisions are given in section 6 subsection 2. Residential status of company, the provisions are given in section 6 subsection 3. And the residential status of every other person. What do you mean by every other person? Other than individual, other than HUF, other than company. So who all are covered here? Firm is covered here. Association of person, body of individual is covered here. Local authority is covered here. And artificial juridical person is covered here. So there in basic rules, point number A, against every other person you can write what? Firm, association of person, body of individual, local authority and artificial juridical person. Is that very clear? Okay. So point number 1 says that there are different set of rules for determining the residential status of every person. Point number 2 says that residential status, first of all tell me, you calculate the income for what period of time? Do you calculate income for 1 day, 1 month, 1 year, 10 years, 15 years, how much? You calculate income only for 1 year, that is nothing but your previous year. Similarly, if you want to ascertain your residential status, that will also be ascertained for the 1 year period. Yes or no? So residential status is required to be ascertained for every previous year. It is not necessary that if you are resident in 1 year, then you will always be resident in all the subsequent years also. It may happen that you are resident for 1 year, next year you turned out to be a non-resident person. So residential status can change every year and residential status is required to be ascertained every year. Is that very clear? So point number 2 says residential status of a person is to be determined in respect of each previous year. A person who is resident in the previous year 18-19 may become non-resident in the previous year 19-20. So residential status, once it is ascertained, it is not fixed for lifetime. It can change every year. The way if you have got a rank in CA foundation, or maybe you have got a rank in CA intermediate, it is not necessary that you will also get a rank in CA final. I have seen students getting a rank at CA intermediate and failing both the groups in the first attempt of CA final. So every game is a different game. Similarly, here also you have to find out the residential status every year. Point number C says, have you heard something called a citizenship? What is citizenship? Citizenship means you are a citizen of this country. How do you get the citizenship? Number one possibility, you can get the citizenship by birth. So if you are born in this country, you are citizen of India. Or if you are born in some other country, say for example you are born in US, then by default you are a US citizen. But if you want to get the Indian citizenship, you can give an application to the Indian government, and if Indian government feels that you are morally good person, if you are added to our society will not be polluted. In that case, Indian government will offer you a Indian citizenship. See, it is not necessary that Indian government will offer citizenship to each and every person. I am not. Do you know that there is a Pakistani singer called as Adnan Sami? Are you aware about that? There is a Pakistani singer named as Adnan Sami. He had applied for Indian citizenship before 10 years back, and he was awarded the Indian citizenship just before 1.5 years. So there are people who are looking for Indian citizenship from other different parts of the world. So it is not necessary that government of India may give you the citizenship. So basically citizenship you get by two different ways. Number one, by birth, and number two, by giving application to the Indian government. But when it comes to income tax, citizenship has no relevance in determining the tax liability or determining the total income of a person. So citizenship and residential status are two different things. They are not connected to each other. They are not at all connected to each other. Citizenship means either you are born in that country or you have applied for citizenship and you have become a citizen of that country. And residential status or resident means only that you are residing in that country. Can a person who is a US citizen reside in India? Yes. In that case, he will become resident of India, yes or no? Yes. If you reside in India, you may become resident of India, but still you are which citizen? You are a citizen of USA. In income tax, what is important for us? Citizenship or residential status? For us, residential status is important. Citizenship has no relevance in determining your total income or determining your tax liability. That is what is written in point number 3. It says citizenship has no relevance in determining the residential status of a individual. Point number 4. Point number 4, I will ask you a very simple question. Don't refer to that. Can a person become resident of two different countries at the same time for the same year? Yes. See, residential status rules. In Indian Income Tax Act, rules might be different. In the US taxation law, rules might be different. If we need to decide the residential status, we need to look at which law? Income Tax Act 1961. We are not concerned with means prima facie, will not prima facie make him a non-resident in India. Whether or not he is resident or not will be decided based on what? Will be decided based on the provisions of Income Tax Act. Is that very clear? The way you are doing two courses at the same time, BCom as well as CA, you are managing both the courses. Similarly, an individual can be resident of two different countries at a same time. Point number E says that if a person is resident in the previous year, see point number E says, do one thing, I will skip point number E right now, because even if I try to explain you will not be in a position to understand point number E right now. So we have covered how many points? We have covered 4 points. These 4 points are the general set of rules which are applicable for ascertaining the residential status of every person. But the residential status of individual is decided based on what? Based on which section? If you want to ascertain the residential status of individual, how many sections are applicable? 3 sections. Section 6 subsection 1, section 6 subsection 1a, which is a newly inserted section, and section 6 subsection 6. Is that very clear? What we'll do, we'll complete this page number 17 today. We need to just have a look at the flow chart of residential status of individual. Residential status of individual, up to last year, it was divided in 2 parts. Either an individual can be resident in India or he can be non-resident in India. Now, after Budget 2020 amendment, the residential status is divided into 3 parts. Number 1, either you can be resident. Number 2, or you can be non-resident. And the third possibility is you can be deemed a resident. You can be deemed a resident. For the timing, you forget about the third category, deemed resident. Right now, you just understand that residential status of individual can be divided in 2 parts. Either an individual can be resident in India or he can be non-resident in India. Simply we can say that if a person is residing in India, he is resident. If he doesn't reside in India, he is non-resident. If he is non-resident, then the story is over. Then once again we will try to find out his residential status in the next year. But if an individual is a resident person, then we need to classify that resident category further into 2 parts, whether an individual is ordinarily resident person or not ordinarily resident person. For that we need to refer to section 6 subsection 6. I told you that a person who is residing in India, we call him as a resident person, and the person who is residing outside India, we call him as a non-resident person. If a person is non-resident, story is over. If a person is resident, means he is residing in India, then if he is residing in India for a very long span of time, say 9 years, 10 years, etc., then we call him as a ordinarily resident person. But if he is residing in India only in the past short span of time of 4 to 5 years, then we will call him as a resident but not ordinarily resident. Have you understood this? So, residential status of individual can be finally divided in 3 parts. Either a person can be non-resident, means he is not residing in India, he is non-resident. This is first point. Second point, a person can be resident. If he is resident and residing in India for a very long span of time, then along with resident, we say that he is ordinarily resident. This is second possibility. And third possibility is, if a person is residing in India, but in past he has resided in India for a very short span of time of say 4 to 5 years, then we say that he is resident but not ordinarily resident. Now, how to decide whether he is resident, non-resident, ordinarily resident or not ordinarily resident, that we'll discuss in tomorrow's session when we move on to the actual provisions. Is that very clear?